I think we're going through this breather.
From a broad-based standpoint, I'd be careful to be short.
We are optimistic about the overall technology cycle here.
Next year, we should see a broadening of this AI scene.
Going into 26, our call is for a continued expansion of breadth in the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. It's Thanksgiving Eve, and it's an open interest anchor takeover of surveillance. I'm Danny Berger alongside Matt Miller this morning, and it's a market in recovery mode. 3 straight days of gains for the S&P 500, nearing a fourth, just 2% away from all-time highs. As NVIDIA congratulates Alphabet on its success in the horse race for AI chip dominance. Meanwhile, in Washington, D.C., there's a different kind of race. Bloomberg reporting that NEC Director Kevin Hassett is the president's frontrunner for Fed chair. Matt, that sent 10-year yields to 4% and helped this overall risk rally.
Yeah, you know, it's interesting. I have spoken to Paul Tudor Jones about this a couple of times, and he said he expects President Trump to put the yesest yes man there is in the chair at the Fed. And I guess that is Kevin Hassett right now. So investors are betting he has a pretty easy time of lowering rates to right now. We show 3% as the terminal rate.
I think it's probably important that that's the interpretation, right? Like, oh, great, we're going to get a bunch of cuts, not loss of independence at the Fed. If that's what the market was expecting, you probably would have had a bigger reaction, right? So if this was a trial balloon, I guess trial success. Cool, stocks rallied.
I mean,
bonds a little lower.
I think that's a pretty big assumption. You could easily make the argument that there is going to be a loss of independence at the Fed. Not that it's binary, right? Either 0 or 1, but there's going to be far less independence with Hassett, with Myron, with Waller, and whoever else that the president decides to install. So the market just doesn't really seem to care that much.
Okay, can I play devil's advocate for
Yes.
you? Getting spicy at 6 a.m.
Yeah.
They weren't able to oust Cook, right? That's kind of fallen by the wayside.
That's true, but she's a dove.
What maybe Kevin Hassett comes in and needs to prove to the market that he is independent, or else it's a market that will react in a way that President Trump won't want. So maybe in that way, independence is safe and we can all go to sleep soundly at night.
Yeah, we'll see if Kevin Hassett decides to say no to the president.
Meanwhile, it's a market that is feeling confident, at least for now. Again, we are on our track for our 4th day of gains after the biggest 3-day gain for the S&P 500 since May. Euro going a whole lot of nowhere. Your 10-year yield, as we were just talking about, hovering right around 4%. First, it was the weak consumer data yesterday, and then the Kevin Hassett hat tip that helped us rally. We are ever about 1 basis point higher for that. And NYMEX crude, that's at $57.90 as hopes for a Ukraine peace deal sent oil to its lowest in about a month. Coming up on the show, Silverman of RBC Capital Markets with stocks looking for that 4th day of gains. Dan Ives of Wedbush Securities on shifting tides in AI. And Nadia Wiggen of Svelland Capital on what Russia-Ukraine peace talks would mean for energy. And we begin this hour with stocks rising as risk appetite returns after a stretch of volatility. Silverman of RBC Capital Markets writing, there's actually a lot more there's a lot more demand for hedging than is currently priced into the market. The risk of missing out is almost worse than the risk of a drawdown. And I'm pleased to say that Amy joins us now. And Amy, Matt and I were talking to you about a week ago in the midst of some of this downturn in the market. And you were talking about the shadow hedges, the desire for hedges, and the places people were turning to get them. How has that evolved over the past week as markets have recovered?
Video was still up, and then it turned for the rest of the day, Danny. Look, I think part of the problem that I had described was this idea that there is actually a lot of concern about the fragility of a lot of the trades, because they're not only related to AI, they're related to the concentration risk that you see in the Mag 7. But obviously this year, it's been much more about that up crash being something that investors have to be concerned about, that fear of missing out. And so when you do get the down days, you get a little bit more pile on, and you do see that in the skew in the market, meaning that downside demand remains quite sticky. Even when you reverse the market moves and you have more up days, that skew hasn't quite changed as much, because again, that fragility is at top of investors' minds.
What about the treatment of tech, Amy? Because before it was a market that was pricing in all the AI winners would all be that they would all be winners. Things have started to change. We're looking at another day of NVIDIA losing in the pre-market and Alphabet gaining. Has the treatment of these stocks shifted? Has that narrative and the way we price it in started to move?
Yeah, and I think to some degree that actually might be a good thing. So one thing we look at isn't just inter-stock market dispersion, but obviously inter-Mag 7 dispersion. And so, on a day where you have NVIDIA going down, but Google going up, and obviously that story is tied to each other, then it becomes maybe something that's also more diversified. Because one of the biggest concerns has been if correlation rises because it's all one big trade, it's quite incestuous, that fragility is not good for the market, even in a time when things are going up. So if it is the case that one is more of a diversifier for the other, and you don't get that spike in correlation, I know for our investor base, when they're thinking about volatility and hedging, that is a big component in the market structure that is very key for how they diversify the portfolio.
Don't we necessarily have less correlation now among the Mag 7, right? They were all working together, investing in each other. It was a very incestuous, circular economy. And now you've got one against the other. It seems like it would reduce correlation and maybe even reduce concentration risk.
Yeah, exactly, Matt. So it's that diversifier aspect that is important. I mean, I think the thing is there's still that incestuousness hasn't fully gone away, and that's not just in terms of what CapEx investments are, but obviously there's issues on the credit side as well that investors are watching for. So I don't think, this alleviates the whole picture, but I actually think even though it's like Google is going up, NVIDIA is going down, the way that investors are thinking about it is, well, at least my implied correlation on the Intermag 7 is something that could be a diversifier so that this whole market isn't all reaching at once.
Amy, how strong does the retail bid look to you right now? Because we finally had a more than 5% drawdown, just barely, but it happened from peak to trough last week. Are retailers going to continue to be buying the dip? Is that still a huge presence in this market?
So it has waned, and you've seen that in some of the sentiment markers, Matt, but it is something that, we're watching very closely, because I think one thing we've talked about is the reason that institutional investors, just to be clear, have been afraid of, really piling in on hedges. That's why we call it shadow hedging, is that retail bid has continued to stay in the market. Now, there are these extraneous forces. So, for instance, how cryptocurrency is doing, how other factors are doing that are actually quite correlated to that retail bid. So we are watching those extraneous factors closely as well, because it is interesting to see when like crypto is always supposed to be this hedge asset, but in reality it is a risk asset. And then it's also very correlated to that bid that you see in NASDAQ. So I think those things, even though they're not directly tied into the stock market, are very important as factors for sentiment.
Amy, in terms of finding other places to hedge, there was a Goldman Sachs report about what hedge funds are shorting. And one of them that's at historic levels, albeit at a relatively low level, is utilities, 2.3% of free float. Again, that doesn't sound terribly exciting, but that is the most in history. I wonder if that could be interpreted as a hedge for AI, given the close proximity and the correlations we've been talking about. And if it is a hedge, does that make sense as one?
Yeah, I think it does. When you think about what everything comes down to and what could be the bottleneck for large parts of the AI trade, it's just getting enough compute, right? And that has implications not just for the United States, but if you think kind of bigger, it's also geopolitically the race that is going on right now between China and the United States. Again, it's that ability to do compute and what bottlenecks happen. The only issue I see when you think about doing it through utilities is one, there's just not that much market cap relative to other sectors. And two, that liquidity is traditionally not as, I guess, free flowing as other sectors. So if that you think about that as your hedge, I don't know if that is the cleanest that you could have versus, outright owning something as a hedge in AI underliers.
Amy, great to see you this morning. Thank you for joining us bright and early before the Thanksgiving Day holiday. Amy Silverman of RBC Capital Markets. Matt, I want to bring some breaking earnings just coming across from Deere. It's not looking great. Their 2026 net income at the high end It's $4.75 billion. The estimate was above $5 billion. Also, I'm looking at a lot of their sales, what they see for next year. Production and precision ag net sales down as much as 10%. For the agricultural giant, these are not good figures.
Yeah, no, they're bad. If you're forecasting net income between 4 and 4.75 billion, and the street was looking for 5.31 billion, that's a gaping hole that's approaches the level of the UK deficit. So it's a real problem. I'm being facetious. Obviously, the UK deficit, the hole we're worried about there is $20 billion. But this is a pretty big miss for Deere. And I think it's interesting because Deere is increasingly being seen as an AI play, not in the same way that, Caterpillar is building data centers, but they're using so much more AI in their product. The problem is that farmers right now are taking such a hard hit due to the trade war that they can't afford to buy or invest in this new equipment.
I would say how much of this is just a direct read into how much the tariffs are hurting the sector, something that the president obviously has been focused on with the call with President Xi, talking about the purchasing of soybeans. Okay, let's get you an update on stories happening elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Good morning, Danny. Well, White House National Economic Council Director Kevin Hassett emerging as the front-runner to be the next Fed chair. Sources telling us here at Bloomberg, the economist is seen as someone who would bring the president's approach to interest rate cutting to the Fed. Hassett would accept the job if asked, saying, quote, "I want to serve my country and I want to serve my president." U.S. presidential envoy Steve Witkoff is set to visit Russia to discuss a deal to end the war in Ukraine. President Donald Trump shared he's sending Witkoff to meet Vladimir Putin in Moscow next week. Trump also shared he will not meet with the leaders of Russia nor Ukraine until a deal is in its final stages. Hewlett Packard shares trading lower in the pre-market. The company announcing it's going to cut up to 6,000 jobs through 2028 by using more AI tools. The cuts will result in about $650 million in restructuring charges. HP also giving a profit outlook for the current year that fell short of Wall Street estimates. And that is your Bloomberg Brief. Danny.
Bonnie, thank you so much. Up next on the show, a day of reckoning in the UK.
We have the highest borrowing costs of any G7 country. There are limits on the price that banks, hedge funds and pension funds are willing to pay for our debt. The more that we try to sell, the more it will cost us.
More snark from Matt Miller on the UK coming up next alongside Bloomberg's Skylar Montgomery and Koning. You're watching Bloomberg Surveillance. Days of gains, the best since May. Can we make it a fourth? Futures this morning pushing higher, being led again by tech after tech led us to the downside despite the participation of Nvidia. Nasdaq 100 futures up nearly 0.5%, S&P up 1/3%, while Russell 2000 participates in the rally up 0.2%. Under surveillance this morning, a day of reckoning in the UK.
Our borrowing costs were in the middle of the pack compared to other advanced economies. But now, we have the highest borrowing costs of any G7 country. At the budget last year, I changed the fiscal rules to strike a careful balance. To invest more in capital alongside a credible plan to grow our economy and bring debt down, there are limits on the price that banks, hedge funds and pension funds are willing to pay for our debt. The more that we try to sell, the more it will cost us.
Here's the latest. UK Chancellor Rachel Reeves set to announce her second budget, facing a tall order of stabilizing the country's debt and appeasing members of her party. Bloomberg's Lizzie Burden joins us now live from London. Lizzie, just how much of a bind is the Chancellor in today?
A massive bind, Danny. In just about an hour and 15 minutes, Chancellor Rachel Reeves will stand up in there in the UK Parliament, caught between the bond vigilantes on the one hand and the left of her Labour Party on the other. Now, she had rolled the pitch to break Labour's manifesto and raise income tax, But then she's U-turned on that more recently, and her Treasury officials have been briefing us that we can expect a smorgasbord of smaller tax rises in order to fill the fiscal hole. Now, will that be credible with markets, and how much is it going to give headroom against her fiscal rules? The expectation, Danny, is £15 billion of headroom, only a tiny bit more than the 9.9 billion that she left last time, and that isn't really what the market was hoping for. Markets would like to see more, but even then, 15 billion is going to be politically painful for this Chancellor. You remember the words of George Bush Sr. saying, read my lips, no new taxes. Well, a year ago, after her last budget, Rachel Reeves said she wasn't going to come back for more borrowing and more taxes, and here she is expected to come with some more. Already Labour is languishing in the polls. It's never done so badly in the polls. So when it comes to the bar for success, it is very low for Reeves today. If she can avoid a gilt market sell-off and even just stay in the job, perhaps that'll be a mark of success for Reeves.
What does the actual policy pronouncement then look like, Lizzie? If she can't unveil huge, giant measures, what sort of piecemeal type fundraising might we expect?
So here's what the smorgasbord's set to look like, Danny. We've got the front page of the newspapers talking about this tax-heavy budget today. It looks like it's going to be pensioners, savers, workers who are hit by this. The biggest tax-raising measure likely to be a stealth tax rise, where she freezes personal tax thresholds for another 2 years instead of increasing them with inflation. And then we're told to expect a mansion tax on homes worth more than £2 million. Yes, that might be politically popular with the left of her party, but it's not expected to raise as much as some would hope. Then on the spending side of the ledger, it may be that she lifts the two-child cap on benefits, but that would cost £3 billion, and already we know that her party has stood in the way of many of the welfare reforms that the government would like to make. If she backloads the spending cuts to the end of the decade, again, credibility questions come up about debt sustainability. So, of course, we are laser focused on the gilt market reaction to this budget. Yes, you have jitters in the likes of France and Japan as well, but in the UK, as ever, Liz Truss looms over the gilt market. Then you have the currency market. You've seen huge volatility in the pound against the euro, and you've seen traders piling into bets that the pound's going to be weaker against the dollar as a result of this budget. If Reeves can pull this off, it may be that you see a relief rally for sterling. But I would say, Danny, don't judge the market reaction straight away when she sits down. Give it some time to breathe. Give it until tomorrow as well, because of course with Thanksgiving we'll have low liquidity and the UK incredibly exposed to international movements.
Lizzie, thank you very much. Looking forward to your continued coverage of this. Bloomberg's Lizzie Burden. Joining us now is Bloomberg's Schuyler Montgomery Koning. Schuyler, first let me say, so thrilled that you're on the Bloomberg team with us now. And look, people are concerned about volatility, but this is a very different environment from the Liz Truss blow-up. We don't have double-digit inflation. We're not about to get a huge package, probably, of unfunded tax cuts. So what is the risk of volatility in today's budget unveiling?
Yeah, I mean, I think it's something people are watching very closely because there are quite a lot of things that can go wrong. I mean, for me in particular, there's three things that worry me from a market impact and volatility perspective. That's how much headroom do you get? Is it a credible budget? As well as what are the economic implications? So in terms of headroom, as we've just talked about, or as you just showed, the last budget, the only headroom was around 10 billion. So very simply, the market wants more than that. Something around 15 to 20 billion would be quite positive. And for gilts in the pound, I think if we get that, it's quite positive. On the other side, if you don't, it's negative. In terms of fiscal credibility, I think this is really the volatility risk in terms of, yes, we're looking at how credible are those forecasts, but we're more concerned with how does the labor market as a whole, or Labor Party rather, as a whole react to this. So if there's revolt within the party and there's more of a risk of a change in leadership, any new leadership is like to be more fiscal loosening. And so that would certainly be negative for the pound and for gilts. And then finally, on the economic outlook, very simply, worse growth inflation mix, as in both being negative, is positive for gilts and negative for the pound, although I would say there's more nuance there in terms of what's already priced, as in there is room for the pound, there's not as much room for the pound to sell off as there is for gilts to rally.
Schuyler, why are we always so breathless about the UK economy when, the debt level is tiny in comparison to the U.S., smaller than the EU, certainly, and for example, comparison to France and Italy, they have higher deficits. I know that they don't really have a lot of growth in the UK, but inflation isn't off the charts and they're not in a recession. If I look at the pound, it's not incredibly weak or incredibly strong. The same is true if I look at rates. I mean, 450 is like middle of the pack if you look over the last few years. What's the big deal about what we say like a yawning $20 billion fiscal hole? That's like a Tuesday afternoon in Washington.
Yeah, I think it's largely just the scarring we had from the Liz Truss crisis, because you had this trigger within the bond market where you had a move that became very volatile very quickly. It was non-linear. We're still looking back to that. I think, too, there's more of a reaction function where you get higher yields. That means higher debt servicing costs, and it kind of goes out of control. But as you say right now, we're not in a particularly bad situation relative to the rest of G10. Debt to GDP is kind of middling in the pact, and we do have a yield advantage in the UK now. So that would point to relative positivity. And if you can have the economics support you in terms of, in September, we got a clear sign that inflation had peaked. Since then, economic surprises have been to the downside. That's a further indication that inflation will come down from here. That will allow the Bank of England to ease. And so you can get this virtuous cycle rather than the kind of negative cycle that we had previously, where you have lower inflation, lower yields, lower debt servicing costs. And that's more supportive for the general outlook in the UK.
It does seem, like the French are much more in catastrophe stage, right? Nothing works there. And yet they only pay 3.4% to borrow money for 10 years. And they don't have the kind of fluctuations that gilts have. There's not as much of a worry about a trust moment. Why is the UK so reliant on the whims of external investors? Is it all down to the sort of self-inflicted wound of Brexit?
I think that's absolutely part of the story, and it's quite interesting because the French also has a large amount of their debt that's owned by foreign investors. So you'd think that looks risky as well, but I think the main difference perhaps is that there's this ECB backdrop, or the rest of Europe can come in and save the French if there was a big issue. And I think particularly for me, my view is that, that's not as strong as a stop on French spreads, but you don't get the same kind of worries as you do in the UK because we've made such big mistakes in the past, like Brexit, like the Liz Truss crisis, and definitely there's some scarring that means you get a bigger reaction here than elsewhere.
Skylar, isn't the flip side of that just if there is a bond market rally, the government, like all of a sudden, yay, much lower costs, it kind of helps fund itself?
Yeah, I mean, absolutely. And I do think that's the trend unless we get something particularly bad from this budget. I say the biggest risk is that it's actually politics rather than the policy itself. I think the government has actually prioritized fiscal prudence. You've also had a test of the market before this, as in because we've had budget headlines come through, yields have already risen on the idea that we weren't going to get the income tax hikes that we were expecting. So the government knows what the yield market reaction is, and they can respond to that, or they can take a signal from that ahead of the budget. And so hopefully policy is much better, and we just have to worry about the politics side, which is admittedly a bigger risk.
Skylar, thank you so much. That's Bloomberg's Skylar Montgomery-Koning. Now, don't you think some of the excitement around it is just the fact that we had a former prime minister and a head of lettuce going head to head?
Yes.
And there's so much pomp and excitement around it versus the actual numbers themselves?
Absolutely. I mean, it's the whole thing, right? The fact that they have a monarchy, the fact that the city of London is, for financial markets, so sacred and so important still,
yes,
makes us pay much closer attention to what's going on in Great Britain than we do, for example, in Germany, which is a far more important economy, and yet no one knows what's going on there.
I promise 7:30, the budget release will still be exciting, even if it's not as big of an economy as Germany. Coming up on the show, Dan Ives of Wedbush on why big tech has room to rally into year-end. Plus, Vonnie Quinn has your morning movers. Deere taking a dive on an earnings miss. This is Bloomberg. A rally greeting this holiday-shortened week. Good morning. We're on track for a fourth consecutive day of gains, led this time by tech, whereas this time last week it was losses led by tech. NASDAQ 100 futures up nearly 0.5%, the S&P up 0.33%. Russell 2000 futures also participate in the rally. Helping things out was a rally in this bond market yesterday. It started with weaker consumer confidence data and other weak data that sent yields lower. This morning, they're ever so slightly higher, but they remain around the level that they were before. You add to that a Trump top pick of Kevin Hassett for the Fed nomination. That's solidifying a 4% on your 10-year yield, your 30-year yield this morning at 465.50. 3 hours away from the cash open. Let's get a check on your morning movers. With that is Vonnie Quinn. Hey, Vonnie.
Hey, Danny, well, you just broke Deere's earnings a few minutes ago, and it's true, there's no visibility for a farm economy recovery just yet, and you can see that in Deere's earnings. Now, the stock is up year to date, about 17%, down, though, in the pre-market after its forecast disappointed. It gave a range for net income of between $4 and $4.75 billion, but the Bloomberg estimate for the full year was $5.3 billion. So that'll tell you there's a yawning gap between the estimate and what Deere is coming in with, and even Deere isn't sure. Obviously, crop prices have been down. The president's tariff policies haven't been helping. And this recent deal with China to export more crops, well, there's no knowing how much that will actually help. So you can see all of that in Deere's results. Let's move now to the story from yesterday, TPUs versus GPUs. It is continuing today, maybe not as frantic of an investor reaction, but we are still seeing Alphabet shares move higher again, more higher, if you like, 1.8%, and Nvidia suffering just a little bit more. That's more than $700 billion now of Nvidia's market cap just in the last several sessions alone, not just thanks to this story. It was also AI bubble talk and so on. But don't forget, Nvidia has given a forecast of revenue rising 63% this year. Not bad for any company. And finally, we want to take a look at HP because it's talking about job cuts, and even that is not cheering investors this morning. Often job cuts do, right? It says it's going to use AI tools and things like customer service, product development and so on, and that will lead to job cuts of about 4,000 to 6,000 over the next 3 years. There will be restructuring costs associated with that, but basically the forecast also disappointed, and that stock suffering in the pre-market. That stock, by the way, this year is also lower, so it is down 14% this year.
Vonnie, thank you very much for that. Your morning movers. Now, on our radar this morning, U.S. presidential envoy Steve Witkoff heading to Moscow next week, accompanying other American officials. This comes after Witkoff spoke with Vladimir Putin's top foreign policy aide in the latest push to end the war in Ukraine. Elsewhere, UK Chancellor Rachel Reeves preparing to announce the long-awaited autumn budget today. Reeves will be presenting a package of tax hikes and other measures she says was designed with bond market investors in mind. Back here in the U.S., White House National Economic Council Director Kevin Hassett has emerged as the frontrunner to be the next Federal Reserve chair. Hassett says that he would accept the role as a search for a new central bank leader enters its final weeks. And Matt, here's someone that would agree with you that it's bad, or at least Paul Tudor Jones, that it's bad for independence. Joe Kalish of Ned Davis Research. As a member of the Trump cabinet, Hassett would be the worst choice for Fed independence. I also find him to be a subpar communicator, but Trump would want to fill the role with a loyalist.
Wow. Yeah. I mean, I don't think that PTJ would go that negative, right? And I don't think that, at least in my conversation with him, he wasn't saying this lack of Fed independence was a huge loss for the market. He was just saying that Trump would likely pick someone who gets rates down. And you heard that last week. Was it last week or was it? Yeah, last week he said he would fire Scott Bessent if he didn't get rates down at the Fed. Now, he was joking, right? But he's pretty serious about this. And I think the market sees that and realizes that he has so much power, not only with these installations, but also could potentially suspend all of the regional Fed governors and put his own people in there as well. So it could be a real Fed takeover.
By the way, Neil Dutta makes the point, if you think it's hard to cobble together a consensus right now, it's going to be 3 times as hard with Kevin Hassett at the head. And what does that mean for, I mean, it is a policy tool, right? Like Fed communication, saying what they're going to do. It moves markets, it moves bond markets. What happens if they lose that tool and you can't get any consensus because you have a loyalist at the top of the Fed?
Right. I mean, I feel like there are already enough non-Trump appointed doves on the Fed as well, right? You mentioned Lisa Cook, for example. And when she or others see the labor market weakening, their knee-jerk reaction is going to be to loosen rates. And they're less concerned about inflation. Let's be honest. No one really believes in a 2% target or reaching that target. Clearly, for the Fed, 50% above that is a fairly comfortable place to be. So I'm not sure they're going to get super hawkish.
Yeah, what is it, 4 years above target now, and we're haven't done anything
and
about
we're
it.
Still cool.
So
no one seems
cool.
to care, right? Everyone's like 3% is fine.
Yeah, we're okay. It's the labor market we're concerned about. Let's turn to tech.
Yeah, because unemployment is 4.4%.
Yes,
freakishly
it was
high.
Almost rounded up to 4.5.
Yeah.
We'll have you know. All right, let's now turn to tech. Competition heating up among AI leaders. Nvidia saying that its chips remain a generation ahead of the industry, following reports that Google's AI chips could pose a threat. Bloomberg's Matt Bloxham joins us now for more. Matt, where do we stand on this competition of who will reign supreme? Is it really a winner takes all?
In the chip space, I don't think it is. I mean, clearly, NVIDIA's almost taking all of it right now, and I think everybody expects over time for competition to emerge, and we've been seeing that for a while, not just with Google's TPUs, but rivalry from the likes of AMD and Broadcom too. So I think if the AI bubble doesn't burst and continues to get bigger, then there's plenty of space for NVIDIA to compete alongside the likes of Google and others, and for them all to kind of do pretty well out of it. And I think there is quite a big difference between how customers perceive an NVIDIA chip versus a Google chip. The NVIDIA chips have got a much kind of broader range of applications, whereas the Google chips are quite specific in terms of the kind of use cases they're put against. And obviously it's only just started to make those chips available to external customers, with one of the big, and with Anthropic, one of the big large language model platforms being the kind of big win that they announced last week.
Matt, can we also talk about NVIDIA's response? I kind of teased at it in the intro to you, but posting yesterday, we're delighted by Google's success. They've made great advancements in AI, and we continue to supply Google, and then goes on to say, basically, we are better than them. When in your career, have you ever seen a tech company congratulate one of its rivals on its successes?
Yeah, it's a good question. I probably could think of some, but off the top of my head, I can't. I think it makes sense for NVIDIA. They are really want to be the primary provider to everybody that's involved in AI. And Google is a massive customer as well as competitor to them. It's rivaling OpenAI, and NVIDIA wants to have bets on all the players in the game right now. So I think it makes sense for them to kind of maintain that kind of cordial and positive relationship with Google, and the same way too, because although Google can increasingly shift technology to its own chips, there's still an important need for them to have NVIDIA in the short term, for these kind of wider applications, but also from a supply perspective too. So it kind of makes complete sense that things are very friendly and cordial between the two of them.
Matt, thank you very much. That's Matt Bloxham of Bloomberg Intelligence. Dan Ives of Wedbush remaining bullish on NVIDIA, writing, NVIDIA is the indisputable Rocky Balboa champion of the AI revolution, and that is not changing anytime soon on the chip front. Pleased to say that Dan joins us now. Dan, great to see you.
Great to be here.
Okay, I want to ask about the post, because you had that post of them saying, congrats, Google, but we're better. They also responded to Michael Burry's takedown of the depreciation thing. It kind of gives a feeling that, NVIDIA cares about the fact that their share price is falling, and they're trying to fight back against it. What do you make of this sort of PR push they're doing?
Yeah, so I view it a little differently. Look, I mean, at the end of the day, there's one godfather of AI, and that's Jensen. I think Jensen, right now, it's the recognition that they're transparent. In other words, NVIDIA is not trying to hide anything. They're ultimately saying, hey, we are out there front and center, and it just comes down to demand and supply is 12-1 for their chips. I mean, I saw that being in Asia for the last 3 weeks. So them congratulating Google, AMD, and others that are going to be successful, it continues to be NVIDIA's world, and everyone else is paying rent. But the reality is that they are not going to sit there and hide behind some PR when it comes to, whether it's Burry or anyone else calling it a bubble. I mean, Jensen's going to be out there front and center because, in my opinion, it continues to only be 10:30 p.m. in that AI party that goes to 4 a.m.
But, this makes me think a lot of Intel back in the day when we were all rushing out to get the 386 and then the 486 and maybe the Pentium, right? But then Apple was like, why are we giving them these margins? Let's make our own chips. And so did everyone else. And now Intel obviously needs a sort of government bailout in the form of a stake purchase. Why isn't NVIDIA vulnerable to the same kind of vertical integration at these, if Meta, if Google, if Amazon all make their own chips, as they are doing?
It's a great point, and I get the comparison. They're 4 years ahead, in my opinion, of really anyone else in the world, including Huawei, right? So it comes down to like, now will there be a gap narrow? Big tech's going to continue. They're going to go and make their chips. You'll see that they'll vertically have that ecosystem, and that's a great thing. Because the reality right now is like 12-to-1, demand and supply. In other words, NVIDIA doesn't have enough chips to ultimately meet demand, right, relative to what we see. But it speaks to my point. It's about the second, third, fourth derivatives of AI playing out. You have 3 to 4 trillion that's going to be spent in the next few years. To call this a bubble, it's wrong. As someone like myself that covered tech stocks in the late 90s, it's a 1996 moment, not a 1999 tech bubble moment. That continues to be our view.
How does that 3 to 4 trillion of spending get funded? Famously, Sam Altman was asked on stage a couple of weeks ago how he's going to fund his $1.4 trillion in CapEx plans with only $13 billion in revenue, and he just got so angry that he declined to answer the question. Right? I see that ChatGPT has right now, I think, they have a $20 charge, right, for the account that I pay double because I have a work and a personal account, but they're not making massive amounts of revenue. 35 million people are signed on, and it could turn out to be like the Friendster or even maybe the MySpace of AI. Where does this revenue come from?
Yeah, well, see, look, today it's still enterprise. When we think about the enterprise, only 3% of companies have gone down the AI path. So when you look and that's just in the US. Globally, that's just actually starting with sovereigns, what we're seeing in Asia. So when I look at OpenAI, I view it as, it's not just going to be a ChatGPT. It's about what that's going to be on the enterprise, consumer. The consumer applications haven't even started relative to
But it has
Apple
to come quick, right? I mean, remember when the dot-com bubble burst, it took years and years to make up the revenue that we needed to pay for the fiber outlay in the beginning.
Yeah, and I think for OpenAI, for every dollar that they're spending in terms of the stakes that they're taking, just like NVIDIA, they'll get $12, $15, $20 back in terms of revenue.
If we're, though, talking about who wins the enterprise race, I mean, wouldn't that be Google, though? They already have relationships with 40,000 companies. And then when it comes to consumers, they know that name so much better. I mean, increasingly, obviously, they know about OpenAI and Sam Altman and ChatGPT. But especially with that enterprise relationship, who's to say that OpenAI wins out on that horse race?
Look, I think there's going to be many winners, right? I mean, from NVIDIA on the chip side, when you talk about Microsoft, where they stay on the hyperscale, Oracle, and I think that stock's been way oversold here. But look, the reality is, you go back earlier this year, the New York City cab driver was bearish on Google. Now look at it, because it's my view, it's not just on enterprise with GCP, with Google Cloud, with what's happening on chips along with Broadcom, but also, you look out, they're going to ultimately have that Apple deal. I mean, Apple is going to have to bet on Gemini as their AI partnership, which is another benefit here. So I think it just speaks to our view is that, it's not just about NVIDIA. And I believe NVIDIA ultimately is a stock that goes much higher here, 225, 250. But it's about the second, third, fourth derivatives playing out across, I think the world. And for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
So NVIDIA at the lowest in the month, is this just like the most incredible buying opportunity that we're going to see for this company?
Every time this sells off, you own it, because it's my view, it's $5 trillion and ultimately it's $6 trillion. Because look, there's only one godfather, right, and that's Jensen. And there's one chip in the world fueling the AI revolution. And that continues to be NVIDIA. There will be other, anytime if there's a DeepSeek moment, you'll have Google TPU. There's going to be other things that happen, but nothing is going to get what I view as really this Rocky Balboa of the AI revolution, which is, Jensen and NVIDIA.
You must have the most fun Thanksgiving Day conversation around the dinner table. I'm trying to get invited over to the Ives household. That sounds like a good time.
Look, and again, the goal is a lot of food, a lot of sports, and maybe some AI talk here and there.
What more could you want?
Who's Penn State playing this weekend?
And we play Rutgers, and then we'll have our new coach by early next week, and and then we start the upward climb, which I'm very optimistic.
Things are looking good. Dan, thank you so much for joining us. Dan Ives of Wedbush. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Danny, thank you. UK Chancellor Rachel Reeves getting ready to announce her second budget. She's expected to present a package of tax hikes as well as a possible mansion tax and higher alcohol and dividend taxes in an effort to close a fiscal hole and tackle the country's cost of living crisis. Warner Brothers Discovery is asking potential buyers to submit new sweetened offers after getting an initial round of bids. Sources telling us here at Bloomberg, the parent company of HBO and CNN wants the new offers by December 1st. Paramount, Skydance, Comcast and Netflix are looking to buy some or all of the company. US airlines are preparing for the busiest Thanksgiving travel time period on record. Airlines for America predicting a record 31 million passengers will travel from November 21st through December 1st. A cold snap and forecasted thunderstorms are raising the threat of delays. Fuel supply constraints and tech outages could also add disruptions. And that is your Bloomberg Brief. Danny.
Bonnie, thank you very much. Up next, making progress towards a peace deal.
25,000 soldiers, Ukraine, Russia. In the last month, 25,000 soldiers have died. So I think we're getting very close to a deal. We'll find out.
Nadia Wiggen of Svelland Capital joins us next as oil falls to a one-month low. You're watching Bloomberg Surveillance. Counting down until Thanksgiving, and we are rallying on a likely lighter volume market, as we have been all this week, getting a lift yet again this morning from Google. Dell's earnings yesterday adds to the outperformance for the NASDAQ. Meanwhile, your S&P 500 up about 0.33% in this future session, while your Russell 2000 up just over 0.1. Under surveillance this morning, making progress towards a peace deal.
I've also ended 8 wars in 9 months, and we're working on that final war. It's not easy, but I don't know. I think we're going to get there. 25,000 soldiers, Ukraine, Russia. In the last month, 25,000 soldiers have died. So I think we're getting very close to a deal. We'll find out. I thought that one would have been gone quicker. We did 8. I thought that would have been an easier one, but I think we're making progress.
Here's the latest. U.S. envoy Steve Witkoff is set to meet with Russian President Vladimir Putin in Moscow next week to push towards a peace deal with Ukraine. Bloomberg's Greg Sullivan joins us now from Dubai. Greg, how close are we to any sort of deal?
Well, it's unclear. There is definitely a flurry of diplomatic action happening. As you said, President Trump has dispatched his U.S. envoy, Steve Witkoff, to Moscow. The Kremlin has confirmed that he is expected next week and will likely meet with President Putin. But the Kremlin also pushed back on the idea that a deal was imminent, saying it's too early to talk about that right now. The Kremlin or the Russian officials have confirmed that they've seen the peace proposal, but haven't had a chance to review it quite yet. And even yesterday, when there was a report that Ukraine had signed on to the peace proposal, aside from a few minor issues, we then saw Ukrainian President Volodymyr Zelensky seemingly rebut that, saying that conversations were ongoing. We know that there has been some progress made. President Trump has signaled a note of optimism, getting closer to a deal, and even Ukraine has seemingly backed up that there has been some progress towards that. But huge issues remain, and it's unclear how those will be breached at this point. Issues like the land territory issue, as well as security guarantees.
Greg, thank you very much. Bloomberg's Greg Sullivan in Dubai. Turning to oil now, with crude prices edging lower after hitting 1-month lows. Nadia Wiggen of Svelland Capital says the removal of sanctions of top producers Rosneft and Lukoil would be key to supporting the market, writing a potential reintegration of Russian oil into global markets would have the biggest effect on shipping markets. Nadia, I'm pleased to say, joins us now. Nadia, it's already an oversaturated market. So what happens if we do get those additional barrels of oil?
Well, exactly as you say, right now, in the last 3 months, if we look at September, October, November, we've built up 200 million barrels of crude on the water, meaning it's loaded and it is not delivered. A proportion of that is sanctioned oil. That is coming from Iran, coming from Venezuela, and most importantly, Russia. And those Rosneft Lukoil barrels are what have really been pulling up markets in the last month. You know, we were heading towards the 50s on the price side, and then we suddenly had the sanctions announced on Rosneft and Lukoil, and we had, of course, pressure being put militarily on the outskirts of Venezuela. Now, if we start to pull back on those sanctions because Trump feels he's getting a deal or something like that, and he doesn't have to go as hard on Russia, then that would really change the marketplace. But so far, the market is still waiting for real evidence. We had a bit of a sell down, but now things have calmed down.
How dangerous or how severe is the risk that we actually do put harsher sanctions on Russia, that this doesn't go well and President Trump reacts very negatively towards Vladimir Putin in terms of, you know, the oil industry?
Yeah, I mean, Trump has specifically sanctioned now Rosneft and Lukoil, which have been a very big deal. We're talking about 2.7 million barrels per day of crude, 900,000 barrels per day of refined products. There are still other producers out there. And of course, he could sanction the whole of Russia if he were to get fed up. Now, it is safer for him to do that when we have this looming oversupply of oil that is starting to be visible. Analysts have been predicting this for half a year, if not a year, but now we're actually starting to see it on the water. So it is a safer time for him to do that, especially when China right now is not able to import more Russian oil, sanctioned oil, because of sanctions specifically on their ports as well.
If we do get a peace deal, Nadia, and those barrels come off the water and go into gas tanks, whose production gets displaced? Does U.S. shale eat that up? Does OPEC eat that up? How does that work out?
Well, it would be a mixture. Initially, of course, we already would expect to see some slowing down in shale production, especially the smaller independent producers. The Exxons and so forth, they are more protected. OPEC so far has been indicating they're going to keep the market supplied. They're going to not increase oil production in the first quarter. But we think that if we do have this oversupply coming, then definitely in the second quarter, they will be cutting. Russia, of course, is a member of OPEC. They are under delivering in terms of into the market around 150,000 barrels per day this quarter versus their target production. Historically, they have not abided by the rules particularly well in recent years during this war. So the question is it really about exports that are keeping Russian oil away, which is what we think it is, or is it a production problem? And that's where, you know, it could be even Russia needing to ramp up on that side and not just shale and the rest of OPEC.
Hey, Nadia, we're going to have to leave it there. Thank you so much for joining us this morning. That is Nadia Martin-Wiggen, a Svelland Capital, as oil prices steady this morning after dropping to their lowest price in a month, currently at $57.92 for WTI. Coming up next in the second hour, Bloomberg Surveillance, Debbie Cunningham of Federated Hermes, Wendy Schiller of Brown University, Jayati Bharadwaj of TD Securities, and Bloomberg's Lizzie Burden from London on the UK budget announcement. You're watching Bloomberg Surveillance.
We're optimistic. I think we see the economy running, particularly here in the U.S., at a reasonable clip.
The data that we've been getting paints a picture of a slight tension between the two mandates of the Fed.
The Fed needs to do more. The Fed needs to cut rates.
The market's really telling you that December we're not likely to see a cut.
The key thing with cuts is even if they do come, I don't think they change the tone of the market meaningfully.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
You are just 24 hours away from your Thanksgiving Day turkey, probably a little bit more than that, but no rest for the United Kingdom, with 30 minutes for them until the annual budget statement. Meanwhile, back in the U.S., the rally rolls on. clocking the biggest 3-day gain since May for the S&P 500. That happening despite an Nvidia that's trading at its lowest level in a month. Matt, it keeps losing out to Alphabet. It's happening yet again in the pre-market. Alphabet up, Nvidia down.
Yeah, I think it's absolutely fascinating. I have yet to spend significant time with Gemini 3.
You're switching though, right?
I am in the process of switching.
Okay.
I've downloaded the app. But I'm still so reliant on ChatGPT because, as I say, I subscribe to it in 2 different ways, and I use it as an hourly part of my life. It helps me cook my meals. It helps me deal with my healthcare issues. It helps me work on my Harley. Like, it does a lot for me.
Now I'm so worried about what happens if it ever gets taken away from you, given that. But you know what I think one of the more amusing turns of this has been? Was the fact that Nvidia responded to it. The fact that their post on X basically said, congratulations on your huge success, but we're better. And then they also responded to
we're better and we're bitter.
And they're bitter too, Freudian slip. They also responded to Michael Burry. Honestly, I said this to Dan Ives and I believe it. It feels like Jensen Huang cares about the share price. It feels like a little bit petty, if anything. Can you imagine BlackBerry being like, congrats, Apple, on your great iPhone?
No, and I was trying to think of another instance in which one big modern tech company has congratulated another on its success. I can't really think of one. If you have one, write in. But I just think it's fascinating that we go from, Hopper to Blackwell to what's the next one called? Rubin, right? It reminds me of 286 to 386 to 486 to Pentium, and now no one knows what those things are.
And you can throw TPUs into that. Of
Yes,
Google
exactly.
saying, we have something much more specific, something more energy efficient, and something that people will want to use. The question is will we start to see that switch over?
TPUs, Trainium, MTIA. I mean, a lot of these companies are going to want to vertically integrate and make their own chips, which may be more efficient and use less energy, cheaper, and even produce better chatbots.
I think your point about Intel going the same way was a great one. Who's to say that doesn't happen again?
Jensen Huang is the Andy Grove of AI.
I think he would hate that comparison, and I think Dan Ives would say he's not. He is the Godfather. He is the Rocky Balboa. All right, a check on your markets this morning. As I said, Nvidia is down, and maybe it's a good thing that we have been able to post gains without the help of Nvidia. By the way, because of that decline, Apple is getting closer yet again to taking over as the biggest company. S&P 500 futures on the lows of the morning, up just 0.1%. Your U.S. 10-year yield still around 4% after that poor consumer confidence data yesterday. NYMEX crude that trades at the lowest in a month at 57.89. Coming up, Debbie Cunningham of Hermes as a frontrunner emerges to be the next Fed chair. Wendy Schiller of Brown University as President Trump pushes China to buy more U.S. farm products. And Jayati Bharadwaj of TD Securities as UK Chancellor Ives lays out her autumn budget. We begin this hour with stocks rising on rate cut bets and the news of a potential frontrunner to replace Fed Chair Powell.
If the president asks me to be Fed chair, then I'll do it. But if I'm not Fed chair, don't be disappointed for me because I love the job that I have right now. If he were to ask me to be Fed chair, then of course I would have to say yes because I want to serve my country and I want to serve my president. But we'll see how it goes. There are a lot of great candidates.
Here's the latest. White House National Economic Council Director Kevin Hassett as emerging as the favorite to be the next Fed Reserve Chair. Debbie Cunningham of Hermes joins us for more now. Debbie, what difference would it make to have a Kevin Hassett atop of the Fed versus the other candidates like Rick Reeder, like Waller, like, again, Michelle Bowman? How much of a difference would it make to have Hassett instead?
Well, I think with Hassett, you get the economic aspects of it that obviously are very key to any kind of Fed guidance and Fed decision making. Whereas with somebody like a Rick Reeder, you've got a little bit more of a hands-on market experience, and get a better idea of what both the fixed income and the equity markets will do pending certain decisions of the Federal Open Market Committee. So I think it's two different types of qualifications, but I think the qualifications are equally good. And we've had both types of Fed chair equally successful from a historic perspective. So if Kevin Hassett is the choice and is trusted by the president and allows the Federal Reserve to go on in a less hassled way than what has been the case so far in this presidency, I think it's a good thing.
So, Debbie, you're almost arguing that it would give the Fed, the FOMC, shelter. But what does it mean for communication of the Fed? Previously, the markets cared the most when they heard from Chair Powell. Just over the past month since the last Fed decision, it's been, what does his top lieutenant, Williams, say? It's, what does Mary Daly say? Because she often sides with Powell. It's become a lot of reading tea leaves to decide the direction of this bond market. Do you expect that to continue to be the trade from here on out?
Well, I do think Fed speak is inherently important, and certainly the Fed speak that comes from the chair is most important of all, as well as the voting members, as well as the president of the New York Fed, Williams. So I think there's a huge place for that type of informational content, in addition to the economic information that we receive on a now regular basis since the government shutdown is completed. I do think, though, based on some of the comments that Treasury Secretary Bessent has made just in recent days, that there may be some attempt to make this Fed a little bit simpler, which I'm not in 100% agreement with. I mean, I like the clarity of the Fed. I like the information that they provide to us. I like the daily commentary, outside of, the silent times ahead of meeting votes. So I think it's important, and the market has become accustomed to it. I also think the various measures, IORB, the Fed funds, the bottom of the range, the Fed funds target range being the RRP rate, the securities lending rate being the top. All of those things are important aspects of Fed policy, and I think help transmit the Fed's intentions from a market perspective. And I think if there's any thought process of removing those, that is something that the market will definitely balk at.
Well, Kevin Hassett doesn't necessarily have to agree with Scott Bessent, but he does seem to have to agree with President Trump. Are you not worried that he would contort his own economic views to fit the narrative of the president, that independence would be diminished under a Hassett Fed?
Well, certainly there is a concern about that. But I think what we've learned during this presidency's or this term from a presidency standpoint versus President Trump's first term is that he is nominating viable candidates. If you go back to his first term, several of his candidates that were nominated were not accepted. And that's because they really didn't have the pedigree. They didn't have the market experience. They didn't have the background that was necessary. And they were looked at very much more as tools of the president. I think any of the five supposed final candidates that are involved in this search for a chair all have credible statistics, credible backgrounds, credible informational content that will help them guide the Fed in an independent way, and maybe biased towards what the president is looking to achieve just simply because of their party lines, but without taking the job of independence of the Fed in anything other than a very serious manner.
Debbie, what do you expect in terms of the terminal rate? I look at the WERP function on the Bloomberg terminal, and I see that the market's pricing in just below 3%. Is that not a little bit too dovish for the current level of inflation and unemployment?
I do think it is. I think we're looking at a terminal rate that's more like 3.25, maybe, somewhere in the 3 to 3.5%. Certainly not south of 3% is what we're expecting at this point. And that really hasn't changed. Maybe the speed at which we get there is a little bit faster today than it would have been, say, 6 or 12 months ago. But we're still looking at a terminal rate that is north of 3%.
But you do have what presumably is Governor Myron's vote on the dot plot for 2027 below 2.5%, Debbie. And then you add in Kevin Hassett, presumably his dots will look like that too. If it does have the impact of shifting everything lower, are steepeners back on? What's the trade?
I mean, it could be. Certainly, you can get a steepener in various ways. You can get a steepener by the front end going lower. You can get a steepener by the back end getting higher. So I do believe that is a possible trade for the future, but I don't think that's what we have today.
So you don't have that today. How do you handle this? Because it's a bond market that continued to rally yesterday, first in the weak consumer confidence data, and then with the appointment, or at least the reported preference for Kevin Hassett, Debbie.
I think at this point, what we're looking at is a bond market that has earnings that are north of 4% in most instances. You know, the short end is getting close to 3%, but you're talking about 4 to 5% from an investment grade bond market return standpoint, just clipping the coupon. And although there is volatility, there's price action, 30, 40 basis points on a clip at different points in time, depending upon data that's released or news items that come forth. But if you look at sort of the steady earnings rates that we've been seeing from companies, if you look at, yes, we saw a little bit of a dip from a retail perspective, in the September data, but I think to some degree that's a reflection of the government shutdown, and people were a little bit nervous about what that meant going forward. We certainly saw a strong back to school season. We think we'll see a strong Christmas and holiday season, and the consumer remains the bus driver in this case. So we're looking at a bond market that we think is looking at clip the coupon, experience a little bit of volatility, and bets not very far away from neutral are probably the correct the correct process at this point.
Hey, Debbie, thank you so much for joining us this morning. Enjoy the holiday. Debbie Cunningham of Hermes. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, Danny, thank you. European Central Bank Vice President Luis de Guindos arguing that the risk that inflation in Europe will undershoot is limited.
On inflation evolution is positive, both headline and core inflation. Services inflation is that it was, one of the main preoccupations that we had in the near past is also evolving positively, and wage dynamics are also evolving positively.
De Guindos also saying the current interest rate level is the right one. President Trump has shut down a report that he was considering removing FBI Director Kash Patel, telling reporters Patel is doing a great job. Trump's praise comes as Patel faces scrutiny over social media posts during high-profile investigations and his use of a government jet to visit his girlfriend. Deere shares falling in the pre-market after the farm machinery maker's net income forecast missed estimates. Uncertainty remaining over the timing for a recovery in the industry as farmers face low crop prices and the impact of President Trump's tariffs. The company's CEO said he believes 2026 will be the bottom of the large ag cycle. And that is your Bloomberg Brief. Danny.
Vonnie, thank you so much. Crossing the terminal, details of the UK's autumn budget coming sooner than expected. UK Prime Minister Keir Starmer currently facing questions in Parliament ahead of that autumn budget. You're watching Bloomberg Surveillance.
After 8 years of traffic chaos and increasingly creative traffic diversions, residents of Parkside and Marston Grange in my constituency are beginning to wonder whether the A513 at Beaconside is a permanent monument to the traffic cone. In the time that Staffordshire County Council and Taylor Wimpey have taken to complete one stretch of road, we've had 6 Prime Ministers, not to mention Notre Dame burned down and was rebuilt using medieval building techniques. So what can be done to hold developers and local authorities properly to account so that essential infrastructure is delivered on time with minimum disruption?
Well, it's staggering that an important upgrade for drivers to improve their journeys has been delayed for 8 long years. And I understand the scheme is currently being held up by the reform-led council, Telsey, who are proving as hopeless in local government as everybody anticipated. Mr. Speaker, we've invested £24 billion in our roads, and I call on Staffordshire Council to end the delay, get on with the job, and get this scheme started for her constituents.
Alison Bennett.
The rally running out of steam, but still on track for a 4th consecutive day of gains. S&P 500 futures up 0.1%. Something, though, different is happening in the UK with a new budget, the autumn budget, those headlines coming sooner than expected. At first, it was good news. It was a gilt market rally. It was a sterling rally. Look at what's happening now. 10-year yields in the UK up 3 basis points. 30-year yields up 5 basis points. Sure, they have more fiscal headroom, or they're trying to put more than they had expected, Matt. but they have lowered their forecast for GDP, reversing some of the good news for this market.
Yeah, they really need yields not to do this, yes. Right? Or Rachel Reeves, at least, in order to stay in her job, needs a lid to stay on yields because their financing costs, their interest costs are already over £100 billion a year, which may seem trivial in comparison to our $1 trillion a year in interest costs. But for the UK, that's a lot of money, and it has forced out prime ministers in the past.
We'll see whether she can turn it around, the Chancellor of the Exchequer, in about 10 minutes' time. But first, under surveillance this morning, China surprises to the upside.
I spoke to President Xi about a lot of things, but trade and buying our farm products, and he said he agreed with me. I think he's going to very much surprise you on the upside. I think I asked him, I'd like you to buy it a little faster. I'd like you to buy more, and he's more or less agreed to do that. I think we will be pleasantly surprised by the actions of President Xi.
Here's the latest. President Trump touting his phone call with Chinese President Xi, saying Beijing agreed to speed up purchases of U.S. goods. Joining us now is Bloomberg's Mika Solner. And Mika, maybe this is underscored by John Deere having very poor earnings on the back of farmers struggling because of tariffs. Where do we stand between talks with Presidents Trump and Xi?
Yeah, well, right now it looks like it's the start of a potential trade reset when it comes to U.S. and China and how that is working right now. We saw that the president is extremely optimistic to try and get China to buy more agricultural goods and speed up that process potentially before Christmas. He's been under pressure by the U.S. agricultural community. And so we're going to see this. This comes after a very positive phone call on Monday, according to the president.
There's a lot for the two to cover, Mika, and among them as well are the negotiations currently unfolding in Ukraine. Do we get any hint from the president of China's willingness to push Russia to agree to something?
Yeah, this is something that the White House has been really tight-lipped about. I know that this topic of the Russia-Ukraine war was brought up in the phone call between President Trump and President Xi on Monday, but they said that the primary focus was trade and trade negotiations. So, I think to that extent, we don't know what role China might play, but this is also a huge priority, of course, for the administration to try and strike a peace deal as soon as possible.
Mika, thank you very much. That's Bloomberg's Mika Solner. Joining us now is Wendy Schiller, Directman of the Taubman Institute for American Politics and Policy at Brown University. Wendy, these negotiations, as they're happening in the background, we're getting Deere earnings that look really poor because of farmers suffering, consumer confidence that plunging, elections that affordability was at the forefront. How is this coloring the administration's approach as it talks to President Xi, as it negotiates with Europe in trade deals?
Hello, Donnie. I think that the president's got to balance his international clout in delivering for the domestic U.S. political market economically and politically. And he's getting so much pressure on all fronts. And it's now reflected in his poll numbers on the economy. Republicans typically have an advantage managing the economy. They still have an advantage over the Democrats on managing the economy. But the poll numbers for President Trump's managing of the economy have flipped. They were more confident. Now he's underwater. In particular, there's also some dynamics of the midterms in 26. Iowa, for example, big farm state, relies on exports. They have a Senate race. And that Senate race looked, maybe Iowa's gone red, but now it looks like Iowa, the winds are changing a little bit there. They've got a strong contender on the Democratic side, and we'll see who emerges on the Republican side. And that's something that's concerning the Senate. John Thune, in particular, has really been in the president's ear on agriculture, exports, and China. And an understanding that this doesn't just affect President Trump now, it could affect the standing of the Republicans in the Senate in 26.
Yeah, for sure. I mean, we see that farmers don't have enough money to order more John Deere equipment. They lowered their profit forecasts for next year. We have seen already automakers that have had to put production on hold because they're not getting enough rare earths. And then President Trump has this call with Xi in which the Chinese call out Taiwan as a major sticking point. It's not even in the U.S. president's readout, making it look like we're downplaying the important Taiwan issue in order to appease the Chinese. Are we losing this trade war?
Well, Matt, I mean, at the moment, the American people, as evidenced by a number of different polls across different polling companies that sort of tilt one way or the other politically, that the American public thinks we are. That the tariffs are now being blamed for affordability, high prices, layoffs. And this is something I think the Trump administration did not anticipate when he forged this sort of mantra that he was going to stick up for America, get a better deal, negotiate a better deal, and bring manufacturing home.
But every economist with a pulse warned the president about this.
Well, Donald Trump marches to his own tune, his own drummer, and he will emerge claiming credit for deals. China did agree to buy more soybeans about a month ago after John Thune pleaded with the president on this, but it still looks like we're going to have to pay out subsidies to the farmers from the U.S. Treasury to make up for these losses. And the president pivots, as we know, all the time. The question is, how will the Republicans in Congress treat this going into the midterms in 26? Because American public is starting to blame the Republican Party, and that's bad for them. So how effective are they in persuading Donald Trump to maybe renegotiate deals? But right now, it looks like China's still driving the bus on this and affecting, because of our geopolitics in the United States, how we elect people, which states are important. You know, they understand that in China. They understand which markets are where and how that affects our politics. And 26 looms really large.
Is the president too focused on international relations when, you know, we need someone to deal with the problem of skyrocketing health costs here? Apparently, they're going to lay out another 2-year extension to these really inefficient ACA subsidies, which the Republicans really wanted to avoid. But now it looks like we're just going to keep, paying these bills.
Well, Matt, I mean, every president does this. You know, when things are going a little bit south domestically, every president turns the page towards foreign relations. It's not a partisan thing. It's not a Trump thing. But this is what I'm watching. I'm watching, will the Republicans, particularly in the House, come with the president? He clearly wants to sign an extension of these tax subsidies. He doesn't want to have millions of people who can't afford health insurance on his watch next year. That's what he wants to avoid. But the House is making noises that they don't want to do it, that they are uncomfortable doing it. Does he still have the same sway with the House GOP that he has appeared to have all year long? That's what I'm watching over the next couple of weeks and into January.
Hey, Wendy, thank you so much for joining us this morning. Wendy Schiller of Brown University. Matt, at least this is a dynamic that the U.S. doesn't have to deal with. The OBR in the U.K., the Office of Budget Responsibility, issuing an apology for releasing their fiscal report early. They were supposed to wait until we got the autumn budget from the Chancellor of the UK. And their autumn budget had a greater borrowing forecast, and that sent sterling and it sent UK bonds lower this morning.
Yeah, and that's really what Rachel Reeves needs to turn around when she gives this speech. Everyone's looking to see how she's going to deliver some of the details that we're already seeing, right? She's going to raise taxes by almost 30 billion pounds by the 2030 to 2031 budget. She's freezing thresholds. She's charging a mansion tax. She's raising the minimum wage. So she's trying to strike a balance between getting enough revenue and still helping society as much as she can. Remember, this is labor.
Will she be able to strike that balance? Coming up, we're going to take you to London, where UK Chancellor Rachel Reeves is expected to present the autumn budget soon as the UK budget watchdog apologizes for that early release. Will it be a fourth trading day of gains? We're moving higher in the futures session, though on the lows of what we've seen, up about 0.1% for the S&P. NASDAQ outperforms as Russell 2000 futures turn negative. A very different story of volatility in the U.S. Look at what's happened with 10-year gilt yields just over the past 30 minutes. At first, you saw a rally after an early release of an OBR of the UK budget watchdog on what we might get from this autumn statement. And that confusion giving way to losses. 10-year gilt yields up by 2 basis points, 30-year gilt yields up by 4 basis points, with an expectation, Matt, that this is a BOE that will not be able to cut, given that they revised up what they see as inflation. This is a problem for the Chancellor of the Exchequer, given she needs those funding costs to go down.
Yeah, absolutely. I mean, look, we were already at 451. So if it holds here or if this turns around after her speech, if Rachel Reeves can convince the country that she's able to maintain a balance between raising revenue, closing a shortfall, and still supporting her constituency, then I think it'll be okay. It's not going to be likely right now a Liz Truss moment.
Right.
You don't see yields jumping up to 5%.
Well, it's a completely different environment, right? You don't have double-digit inflation. You don't have the dynamics of politics that were quickly changing. You do have a Labour government now. So can she appease the Labour government and appease bond markets? We'll find that out in just a moment's time when we hear from the Chancellor of the Exchequer. First, though, we are 2 hours away from your cash open. Let's look at your morning movers. With that is Vonnie Quinn. Hey, Vonnie.
Hey, Danny. Well, we know the AI trade is skittish these days, right? Nvidia down 14% since the beginning of the month. And we saw another instance of that yesterday when we had one report that one company was in talks with one other company to buy billions of dollars worth of chips. That sent Nvidia down, and that trade continues today. It seems like anything that might be a red flag for the AI trade is really having a big impact. You can see the opposite effect then on Google's parent company Alphabet, up another 0.9%. So that 0.8 adds to yesterday's 2.6% drop for Nvidia, and AMD also having that halo effect. Bear in mind, the companies are having at it. Nvidia, as you pointed out, Danny, tweeting out that, let's bring it on. A lot of analysts are saying, look, this is bound to happen. There's bound to be some competition for Nvidia at some point, and we always knew this was coming. But we'll have to see how the TPUs and the GPUs stack up against one another. Dell Technologies, meanwhile, up 3.25%, just off its pre-market highs at the moment. Now, Dell did raise its annual projections for the key AI server market. So here's some good news about the AI server market, right? But the one point to remember for Dell is that its margins are getting compressed because it has to win this business and it has to get out those machines faster. There is demand for them, but its margins are under a little bit of pressure. That said, shares are up 9% year to date, up another 3+% here in the pre-market. And then I want to point to Deere because this is a whole other sector entirely, down 4.8%. It didn't meet its forecast. It's not going to meet its forecast for the full year. In fact, it's not going to meet it by a long shot. And the CEO said, look, we might see the trough in big ag next year at the earliest. Certainly not this year, as some people were hoping for. Tariffs definitely taking a bit of a toll. And of course, the spat with China, which may be resolving just a little bit. One bright spot, though, in the Deere earnings, and that's small ag beat estimates. So sales there were up 10%. Smaller purchases of equipment and also turf, Matt and Danny.
All right, good to know, Vonnie. Thank you very much. Those shares almost down 5% in the pre-market trade. On our radar this morning, National Economic Council Director Kevin Hassett has emerged as the front runner to be the next Fed Reserve Chair. Sources telling us here at Bloomberg that Hassett is seen as the most aligned with President Trump's approach to cutting. And Matt, say what you will about Fed independence. One of the takeaways is this was a bond market and an equity market that rallied off the back of this announcement. So if this was a trial balloon that was shot up, he's passed so far.
Yeah, no, absolutely. I think the market wants lower rates. I mean, you can see that, for example, on Friday last week when we were mired in this AI doubt, you had Williams say that he's in favor of a cut and he's very aligned with Jerome Powell. And as a result, the market rallied into the close on that day, even after turning around every day previous for the week. So this market really wants cuts in December. It really wants cuts next week, and it's pricing in less than 3%.
I say for all that we're losing our minds over AI, this has been the thing that's moving markets, right? Having a Fed that seemed more hawkish is what sent us lower, and then we worried about AI. And then a Fed that seemingly was willing to cut rallied, and then we're like, cool, Google is doing well. That's just been the added beneficiary. But you're so right. We're laser focused just on this one point.
Yeah, absolutely. I mean, it still is important, obviously, if NVIDIA moves a few percent in one direction or the other, because it's almost a $5 trillion company, but it's worth far less than $5 trillion now. And Google is, did we surpass the $4 trillion mark on Google yesterday?
That I am actually not sure. But one of the things I was looking at is Apple is super close to overtaking NVIDIA because Apple has done well. The iPhone 17 sales have been good, too. So it's getting a lot closer to overtaking that. As far as Alphabet, we'll have to look back and see what
Alphabet is trading at 3.9 $9 trillion. So it did not surpass $4 trillion. Apple is worth more than $4 trillion. And one of the questions I was asking Caroline Hyde yesterday, and she'll be on with us on Open Interest this morning, I'm sure, and on Bloomberg Tech later on, is Apple also working on chips that could emerge as these tensor processing units no one had ever heard of yesterday? Maybe Apple has something similar up its sleeve, although, you know, Siri might be a little bit smarter if they were doing well on that.
Yeah, but Apple has kind of decided that maybe it makes more sense for them not to spend all that money on AI and instead adopt others. Elsewhere, speaking of AI, HP has announced plans to cut up to 6,000 jobs through 2028 by using more AI tools. HP expecting a gross savings of $1 billion a year from the cuts. Okay, two thoughts on this. One, 2028 is a long time away. Who knows what even the world will look like by then? And two, it all just feels like an excuse.
Yes.
All these companies saying we're cutting jobs because of AI, that sounds a lot better than like, hey, things aren't great, so we're going to cut jobs and announce it right before you head off to Thanksgiving.
You know, absolutely. I mean, here's what it seems like is happening. There are new tariffs on imports that are eating into margins at companies like HP, and they need to figure out a way to deal with that without passing all of the tariffs through to consumers. So it falls on labor. And now they have a fantastic excuse to cut those jobs. It's because AI productivity, you know?
Elsewhere, Matt, I know this one is on your radar. Automakers imitating Tesla's electric door handle design are creating a safety hazard for some drivers. The National Highway Traffic Safety Administration seeing an increase in complaints across all models, with several alleging pets and kids got trapped inside after a loss of power. I mean, is everyone just going to be issuing out recalls now, Matt?
Well, I don't know if they'll be issuing recalls. It depends on what NHTSA orders them to do. But I've had my own trials and tribulations with this. I was stuck inside a C8 Corvette E-Ray a couple of months ago before I realized that they had a latch on the floor that helped me override the electric door handle that wasn't working. There are a lot of cars that have, in fact, Corvette was the first one, electric door handles rather than a mechanical latch. So that could be something that automakers turn around, just like they're going to turn around and add buttons back to cars rather than have everything work through your infotainment.
By the way, you and
screen.
Hannah doing great work on this on Hot Pursuit. So a plug for everyone to go listen to it. All right, Matt, elsewhere, we are now hearing from the UK Chancellor Rachel Reeves. She is announcing her long-awaited update to the UK budget. Let's listen in.
Debt and borrowing. No doubt we will face opposition again, but I have yet to see a credible or a fairer alternative plan for working people. These are my choices, the right choices for a fairer, a stronger and more secure Britain.
Order. Far too much noise, and I expected so much better from you, Dr. Luke Evans. You're meant to be a leader in your community. Simmer down, Chancellor.
I'm happy for them to shout as much as they like, Madam Deputy Speaker, as long as they do it from the opposition benches where they can't cause any more damage. I said there would be no return to austerity, and I meant it. This budget will maintain investment in our economy and in our National Health Service. I said I would cut the cost of living, and I meant it. This budget will bring down inflation and provide immediate relief for families. I said I would cut debt and borrowing, and I meant it. Because of this budget, borrowing will fall as a share of GDP in every year of this forecast. Our net financial debt will be lower at the end of the forecast than it is today, and I will more than double the headroom against our stability rule to £21.7 billion, meeting our stability rule and meeting it a year early. These are my choices, not austerity, not borrowing, not turning a blind eye to unfairness. My choices are a budget for fair taxes, strong public services and a stable economy. That is the Labour choice. Growth is the engine that carries every one of our ambitions forward, through stability, investment and reform. The platform from which British ambition can finally get moving again. Because growth doesn't just appear out of thin air. It is built patiently and stubbornly, by people who take risks, by founders who bet their savings on an idea, by firms breaking into new markets, developing new technologies and creating new jobs and new opportunities, by the men and the women who work hard every day in all parts of our country. Our job is not to watch from the sidelines, but to partner with them, backing them every step of the way, to match private enterprise with public ambition. I would like to thank my team of officials at the Treasury for their hard work in preparing this budget. In the spring, the Office of Budget Responsibility forecast that our economy would grow by 1% this year. I said then that Britain would defy the forecasts, and defy them we have. The OBR have upgraded Britain's growth for this year from 1% to 1.5%, reaching the same conclusions as the IMF, the OECD and the Bank of England, who have already upgraded their forecasts. Today, the OBR have published the result of their review of the supply side of the economy. They are clear that this is not about the last 14 months. It is about the previous 14 years. The legacy of Brexit and the pandemic, and the damaging decisions by the party opposite. Cutting public spending, leaving communities and entire regions behind, starving our economy of investment and weakening our public services. As a result of their review, the OBR are reducing their expectations for productivity growth by 0.3 percentage points to 1% by the end of the forecast. They say today, and I quote, real GDP is forecast to grow by 1.5% on average over the forecast due to lower underlying productivity growth. There is an impact on our public finances too. The OBR say that their productivity forecast will mean £16 billion less in tax receipts by 2030. These forecasts are the Tories' legacy, not Britain's destiny.
Order. It is very hard to hear the Chancellor over all the shouting. And Mr. Holmes, you promised me yesterday you were going to be on top behaviour in the first few minutes. Chancellor.
We beat the forecasts this year and we will beat them again. By boosting trade, not blocking it. By increasing investment, not cutting it. By championing innovation, not stifling it. By backing working people, not making them poorer. Brick by brick, we've been building our economy. Building roads, building homes, getting spades in the ground and cranes in the sky. Growth begins with the spark of an entrepreneur. Half of new jobs in Britain are created by scale-up businesses. And we want those jobs created here, not somewhere else. Our job is to make Britain the best place in the world to start up, to scale up and to stay. So we're widening eligibility for our enterprise incentives, so scale-ups can attract the talent and the capital that they need. Expanding the enterprise management incentive so more companies can offer tax-relieved share options. Re-engineering our enterprise investment and venture capital trust schemes so they don't just back early-stage ideas, but stay with companies as they grow. Introducing UK listings relief, a 3-year exemption from stamp duty reserve tax for companies who choose to list here in Britain. And to continue this work, I am launching a call for evidence on how our tax system can better back entrepreneurs and a targeted review with founders and investors at the heart to make the UK an even more attractive place to grow your business. We are sending a simple message to the world. If you build here, Britain will back you. And our retail investment system should do the same. The UK has some of the lowest levels of retail investment in the G7. And that is not only bad for business, who need that investment to grow, it's bad for savers too. Someone who has invested £1,000 a year in an average stocks and shares ISA every year since 1999 would be £50,000 better off today if they'd put that same money into a cash ISA. And so from April 2027, I will reform our ISA system, keeping the full £20,000 allowance while designating 8,000 of it exclusively for investment, with over 65s retaining the full cash allowance. And thanks to our changes to financial advice and guidance, banks will be able to guide savers to better choices for their hard-earned money. Over 50% of the ISA market, including Hargreaves Lansdown, HSBC, Lloyds, Vanguard and Barclays.
UK Chancellor Rachel Reeves delivering the nation's budget, pushing back against OBR forecasts, which trimmed productivity and increased inflation. That means gilt yields still moving higher this morning. We'll continue bringing you the headlines and market reaction throughout the morning. Coming up, Jayati Bharadwaj of TD Securities joins us to react to it. You're watching Bloomberg Surveillance. Under surveillance this morning, defending the UK budget. Here's the latest. Sterling losing steam as UK Chancellor Rachel Reeves defends her autumn budget package. Jayati Bharadwaj of TD Securities joins us now as gilt yields move back to little change. We'll get into the budget itself, Jayati, but can we just start with the way that this unfolded? The fact you had an early release by the Office of Budget Responsibility, the fact they had to apologize about it, that markets sold off because of it, and it put Rachel Reeves in a position just to get on the defense immediately.
Yeah, it's a very unfortunate error to start something so big with. There's been a lot of focus on this for the past month. Gilts have been underperforming, so have, pound shorts have been going through for the last few weeks. So there was a lot of focus on this. Unfortunately for her, it was released 30 minutes earlier, which spooked markets that maybe something's wrong, maybe someone's trying to leak it, and, gilts sold off, pound sold off. Thankfully, things don't seem as dire as markets had feared.
One of the things I took from last year's autumn budget, looking back this morning in preparation for this all-important moment, is that it takes a few days for the market sometimes to digest these things, right? I mean, gilt yields last time stayed initially low and then floated higher and higher until we were at the highest level since the great financial crisis 3 days later. Right now, I'm looking at 448, 449 on gilts. So it's not a concern, but could it get worse?
From what the initial headlines have come out, hopefully it's not going to be one of those concerning cases, because it does seem that they will have more fiscal headroom than expected. They are obviously going to be borrowing, but borrowing less than what markets were expecting, which is ultimately good for the gilts market. So the unfortunate problem for UK has been that it's a very tight problem to solve. There's like 10 different complex moving parts. Everything hinges on what the OBR will forecast, where can the tax increases come, and their fiscal headroom has been extremely tight. But this is one of the better outcomes that could have been expected. And the hope is that now markets can go back to macro fundamentals, go back to the BOE. Will the BOE be able to cut in December or not, and go back to macro? I think that's the hope from this, that this was not as bad as expected. So let's move on.
It's not boring when you have everybody, screaming at each other, this amazing theater, the headmistress of Hogwarts telling people to quiet down. But I wonder if Britain isn't still experiencing pain from the historic mistake that Brexit looks like in the rearview mirror, right? I mean, why is the gilt market so reliant on external investors when you don't have the same thing for French debt or Italian debt or German debt?
The thing is that the UK is one single economy. The euro area as a whole, on the contrary, is shielded because it's a block of many nations. Even for the majority of this year, like you check, like even though Germany was weaker, the peripheral economies actually shielded the euro area bloc as a whole. So that helps the EU region, given it's a bloc of many nations. The UK, when it chose Brexit over, staying a part of the EU, did put itself out there as a single market, which is dominated by its own fiscal concerns, at a time when it's now starting to lag behind other countries on the productivity gap. It's not been able to provide any strong growth impetus that you can close the productivity gap with the rest of the world, which has become a pain point for the UK, unfortunately, and worsened since Brexit, because a lot of your access to capital markets was also hindered after that.
But to be fair, the issue of limited fiscal headroom isn't just a UK problem. It's also a French problem. It's a Japanese problem. So to what degree do we look at today as kind of a test case in government's ability to try to rein that in and to try to calm bond markets and still have foreigners willing to buy it?
It's definitely a very interesting landscape. We've all talked about fiscal for so long, but this was the first year when, fiscal headlines did start dominated. We saw that in the Japanese yen in the summer. We've been seeing that in the pound for the last few months. Also around the One Big Beautiful Bill, in Q2, people started getting concerned about the US Treasury market as well. It's just a landscape we're headed towards, where the developed markets landscape is becoming a lot more dependent on fiscal easing, which is where governments need to be a bigger part of, supporting economic growth. And not every country has the power that US has to keep driving the AI boom and, keep driving productivity higher. Most of the other G10 economies are so far behind. In fact, China is the only country which can compete with the US on that. Unfortunately, not much of the G10.
Yeah, it's this idea of fiscal dominance being the theme for 2026. On the point of the US, if you have Kevin Hassett at the top of a Fed, do you assume fiscal dominance? Do you assume that it's a Fed and a government led by President Trump that just tries to run it hot?
That was definitely the interesting headline yesterday, where, markets were waiting for the Federal announcement before the end of the year. Till yesterday, markets had actually been increasing the poly market odds of Waller, who's seen as the, the economic sound framework for the Fed. But the headlines yesterday that Kevin Hassett might be the front runner spooked markets a little bit, brought that idea that Fed independence, the challenge is still not out of the way. That's still a thing which will be a big deal for markets. And Kevin Hassett is seen as a little bit more of a Trump loyalist and someone who is more just purely going to act on economic rationale. That, if it comes out to be true, and more importantly, if the Lisa Cook hearing goes in Trump's favor, I think that will lead to a big risk premium shock in markets. Rates sell off massively, the dollar sells off massively. That's the start of the major repricing of the Fed independence being challenged.
And what a change that would make. We have yet to see that. Jayati, thank you so much for joining us this morning. That is Jayati Bharadwaj of TD Securities. And Matt, it is both a sterling and a gilt market that has started to calm down. We're basically unchanged at this point. So it does just feel, to Jayati's point, it was just the early release of the OBR statement that spooked markets. But there is this issue of credibility. If that's enough to spook markets, how fragile are gilts?
Yeah, I mean, the interesting thing to me is that they have a lower debt to GDP ratio in Britain than the French, much lower than the US, and far lower than the Japanese. And yet they pay more in interest than any of those national competitors.
We'll continue to monitor the market action coming up in the next hour. It's Barbara Doran of BD8 Capital, Dana Telsey of the Telsey Advisory Group, and Lydia Boussour of EY, and Venu Krishna of Barclays.
I think we're going through this breather.
From a broad-based standpoint, I'd be careful to be short.
We are optimistic about the overall technology cycle here.
Next year, we should see a broadening of this AI theme.
Going into 26, our call is for a continued expansion of breadth in the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's the 30-minute countdown for the next test for this market. Good morning. I'm Danny Berger alongside Matt Miller, taking over your surveillance airwaves this morning. Weekly jobless claims arrive into a fuzzy economic picture. But stocks head for their fourth day of gains regardless, with a more clear view into December. And that is rate cut odds surging as yesterday, gloomy consumer confidence data overshadowing, Matt, the Black Friday shopping season. That data hit when we were on air yesterday, and a bond market rally ensued.
Yeah, absolutely. I mean, we had the gloomy consumer confidence data, but it doesn't always jive with what consumers are actually doing in terms of spending, right? We had some stock movers that were huge. Kohl's was up like 30%, right? Abercrombie & Fitch apparently It's brought back one of those brands from the 90s that was very
Hollister.
So consumers are out there spending. They're just a little bit depressed about it.
I think that Kohl's and Abercrombie are instructive because those are kind of like middle income companies, right? And that's why Macy's did really well off the back of it. So it wasn't a Walmart that's saying, hey, we're dragging people down to come purchase with us. It's companies that already had that cohort and they're spending. And that's good news.
Yeah, although we did have that delayed data, retail spending in September was only a gain of 0.2%. We were looking for 0.4, and the previous month was 0.6. So it doesn't necessarily look fantastic.
Yeah, but that's September.
Yeah,
we can
that's
ignore
true.
it and
That's
move on to
true. Old
greater
data.
things. Meanwhile, in this market, again, we are attempting to put on a fourth day of gains. Some of the rally pre-market running out of steam, despite an S&P that is moving just a little bit higher, 0.2%. Your 10-year yield, that is little change, up almost a basis points to 4%. Again, after that consumer confidence data yesterday, and Kevin Hassett is the front runner. NYMEX crude, that falls 0.1%, trading at the lowest in a month. Coming up on this hour, Barbara Doran of BD8 Capital Partners with stocks eyeing that 4-day winning streak. Dana Telsey of Telsey Advisory Group as retailers face that clouded outlook heading into the holiday shopping season. And Lydia Boussour of EY as we break down the latest jobs data. We begin this hour with stocks rising as Wall Street looks in to keep rallying for Thanksgiving. Barbara Doran of BD8 Capital Partners writing, for now, the AI play is still the place to be. Avoid small caps, staples, stick to quality, large caps, secular growers over cyclical. And Barbara, I'm pleased to say, joins us now. Really wonderful to see you this morning.
Nice to see you, Danny.
I'm interested by the fact you're not looking at cyclicals right now or small caps, especially since there's this hope that we're going to get Fed cuts. Maybe you add in fiscal stimulus and there's this reignition. Why are you still ignoring those sectors?
Well, I think the Fed cut, we may have one more now, but the economy has been doing fine, without aggressive Fed cuts, although we've had about, 1.5 percentage points in the last 14 months. But we've seen a number of false starts in terms of cyclicals and the small caps. And I see the small caps really as a trade because even with rates coming down a little bit, you still have 40% of the Russell 2000 don't make money. They have much higher cost of capital than return on investment typically. And unless rates come down significantly on the long end, I don't see them being helped. So I see that that's continuing as a trade. And in cyclicals, I think you have to be very selective. In industrials, for instance, you want to be, I think, doing industrials that are play on the AI build out and infrastructure, automation, robotics, that sort of thing. But it's hard to see a big reignition here of the economy. I think we're in for good growth, decent growth, and certainly we've seen that with the forward earnings guidance from the companies who just reported a great quarter. And certainly you do have the big, beautiful tax bill, the incentives coming there for CapEx and also bank deregulation, which should free up more capital to lend and spend. So next year is setting up nicely.
I'm kind of confused why that's kind of like a muddling along versus a growth reignition, because all of those do seem like powerful forces, Barbara.
Yeah, well, I think it is muddling along. We've seen this, this year, even with supposedly high interest rates that are, quote, restrictive, you've seen the economy do okay. And the earnings, we just had the 9th quarter in a row where earnings were up. And in fact, they were better than expected, some 13+% versus 8% expected. But it's still, we talked about AI. That is still the driver. If you look at what the Mag 7 did in earnings, ex-Meta, I take Meta out of the mix because they had a $16 billion one-time charge, right? But looking at that, the overall Mag 7 were up 30%, in aggregate earnings. And that's versus a 28+% for the last 4 quarters. So that's still the driver here.
I wonder about the massive CapEx plans that these companies have. You mentioned Meta, right? They want to spend, I think, $100 billion next year. Is that depreciation scary, as Michael Burry warns us about, the fact that they're going to buy all these chips, which may be worth, 20% less the moment they drive them off the lot?
Yeah, the depreciation, what I really keep my eye on is the demand, and if you're looking at very credible sources, see this market, data center infrastructure growing 5 times what it is now. So that really speaks to the demand that's out there. So, he's arguing about what are the real earnings, this and that, but to me, it's really what's the demand, what's the revenue potential, and that is very real. You just saw an acceleration there. I think that continues. We are still in the early stages of this AI rollout. So the concern about, we're in a bubble, cycle. There's too much money being spent. I don't think at all. You're going to see increasing usage of AI as it gets developed.
When do we get that revenue? Because I started this job covering tech companies as Cisco was, the darling of the market. And we were spending as much as we could to lay fiber for the internet in the late 90s, early 2000s. And lo and behold, the revenue didn't come quickly enough. Cisco fell. And only now, like last week, have you made money on Cisco if you bought it in 1999 or 2000?
No, that's true. And I think so much, though, is about the timing, because some of the great tech companies of the past, you had great long runs and made a lot of money. But all things do come to an end. There's innovation, there's markets mature. I think the AI play, this is so big. And what we're seeing, I always mention Meta as the poster child, for what's happening in AI. They have been very early on applying it to their own business. And you've seen the results very quickly. They've increased their user base. The engagement is up. They've really increased improved their ad targeting, so they've improved more dollars. And you've got very early penetration. AI is still, and you heard it from Palo Alto last week. They talked about in their AI security, it's still scaling up because their customers, the big enterprises, are still figuring out how they're going to, what AI they need and how they're going to apply it. So this is going to be, you're going to see these increases in productivity over the next year or two. Exact timing, hard to know. But it will just increase. I mean, look at ChatGPT. I don't know about you all, but I use it all the time. And I increase my usage as I discover more things. And they have 600 million users a week. And so this is really still, and I talk to most of my friends, they're like, yeah, I should try it. There's still so much more to come, both consumer and enterprise.
It definitely feels like something we're waiting for, right? Like, when do the other companies benefit from productivity? I was looking at a Brookings study that was published recently where only 19% of their respondents said that AI increased their productivity. Only 4% said it significantly increased productivity. Barbara, to your point, we're still trying to figure this out. So as you're looking for who benefits from AI, who can use it, where does productivity come from, is it just too early to say?
I think it is. I think we see different companies that are benefiting, but I think over the next 12 to 18 months, there's going to be some dramatic stories to be told about the improvements. And you look at, we're early on autonomous driving. We're early on the deployment of robotics. I mean, for instance, you've got Amazon, has 1 million robots out there. And so they're very early on that curve, but a lot of people are not. And so those are things that over the next year, and again, it's about competition. That's why you're seeing so much spending going into this, because people know, I've got to do that. When you see people like Meta or Amazon who are already early users of all this and the productivity gains they are seeing, as a company management, you go, we've got to do it too. And that requires spending up front.
Isn't there a chance, though, that they go too far with that spending and at some point it no longer gets rewarded by the market? You're already starting to see that in some of the hyperscalers.
Right.
Does that continue on?
There's always that concern, and I think it's a legitimate concern because at some point you can, and this is the thing in a capitalist economy, you don't have central planning, so everybody's rushing, to go after the profitability, typical margins come down. But I think where we are, the demand is so explosive, it's not a 6 or 9 month phenomenon. So at some point, that will be a factor. Right now, as far as the eye can see, you've just got this demand, this virtuous circle that will just keep going and going. But it is something you always have to watch. We know that the lifespan of industries, what happens, you attract players, they all want to make money, and eventually you can overbuild. I don't think it's like fiber, though. Fiber was much more limited. That was a very specific application and very prone to being overbuilt. This is just so
but
much
at the end of the day,
complex.
Data centers are just like empty boxes. Those can't really be used for anything else besides data centers. At least on the infrastructure side, there's a chance we overbuild, no?
You could mine Bitcoin, I guess.
True. Great point, Matt.
No, true.
But that is a place that it feels like we could go too far, and a lot of money has been put into that.
Yeah, no, it is. And because it is real estate in the end, what's going on there. But at the moment, again, everybody's watching that. It's like we're watching private credit, in terms of possible systemic risk. It's not there yet. And so you can still make a lot of money. And that's what we're going to continue to have these frights. Like, I remember the years when Amazon made no money and they kept reinvesting. And at least once a year, investors would throw up their hands and say, they will never make money. And they'd sell the stock off. Well, we now know how that story has ended. And I think we're going to continue to see these concerns with AI and they're legitimate concerns. I just think it's way early.
Barbara, where do you, an investor who already has exposure to the mega cap hyperscalers, an investor who already has exposure to energy, where do you put new money?
Yeah, it's a problem because, in terms of, because you will have new companies starting, new applications and all that sort of thing. So a lot of people, you can look at the food chain, what goes into energy. Like you look at a company like GE Vernova, very expensive. They have great backlog, but they can only build so fast. So where do you put the money there? You can look at the suppliers and the components and all that sort of thing. But for now, it's not only the hyperscalers, it's the Broadcoms of the world. I mean, you saw what Broadcom did with the announcement that Alphabet, is going to be selling their TPUs, which are basically ASICs, custom chips to their customers. And so you still have a lot more to go there. And you're going to have these kinds of announcements, going on. And so that will change. Look at Alphabet. It has, outperformed. And just earlier this year, it was a laggard. They had the antitrust problems. People are like, oh, they're going to be left behind in the AI. And now look at it. It's like, oh, the darling. They're the star of the show.
Now we all know what ASICs are.
And what TPUs are, and it's been a week of education. Barbara, thank you so much for joining us. Barbara Doran of BD8 Capital Partners. Let's get you an update on stories elsewhere this morning. Here's your brief with Vonnie Quinn. Hey, Vonnie.
Hey, Danny, thank you. Britain's Office for Budget Responsibility unexpectedly published the autumn budget on its website ahead of the formal announcement by Chancellor Rachel Reeves. The document, which is usually published after the Finance Minister's speech, was uploaded to the OBR website and available to download on an unprotected link. At least 13 people were killed and 15 more were injured when a major fire broke out at an 8-tower high-rise complex in Hong Kong. The fire has been classified as a level 5, the most severe category. The US is facing a potential electricity crisis due to the surging demand for energy to power AI. Schneider Electric estimates an energy shortfall that could have major impacts by 2033, including outages and blackouts. Power demand from data centers could double in the next decade and could account for almost 9% of all US demand, according to estimates, pushing the grid closer to its limit. And that's your Bloomberg Brief. Danny.
Vonnie, thank you so much. Up next, the morning calls, plus Dana Telsey of Telsey Advisory Group as retailers face a clouded outlook ahead of Black Friday. That's next. You're watching Bloomberg Surveillance.
It continues to be NVIDIA's world. In my opinion, it continues to only be 10:30 p.m. in that AI party that goes to 4 a.m. It's a 1996 moment, not a 1999 tech bubble moment. That continues to be our view.
That was Dan Ives of Wedbush, ever the bull on all of tech, but it's not being treated equally. NVIDIA still down in the pre-market while Alphabet is up, but that's helping to lift the overall market. NASDAQ 100 futures up 0.4%, S&P just over a quarter, while your Russell 2000 futures are flat. Time now for your morning calls. First up, Bank of America raising its price target on coals to $18, but keeping an underperform rating, saying it sees a long road to improved profitability. Next up, UBS raises its price target on Best Buy to $96. Analysts there see signs of an encouraging setup into next year. Finally, Wells Fargo raises its price target on DICK's to $225, highlighting strong earnings results. And let's stick with the retailers. Consumer confidence fell in November by the most in 7 months, signaling some caution heading into the holiday shopping season. Dana Telsey of Telsey Advisory Group writing, quote, businesses face a clouded outlook. The tariffs remain in focus, keeping import costs elevated across key sectors. Dana, I'm pleased to say, joins us now. Dana, how's the feeling of a choose your own adventure? What do you listen to? Consumer confidence dropping? Do you listen to Kohl's or Dick's Sporting Goods saying that earnings are strong? Where does the consumer stand right now?
Overall, and you're right, you have to listen to a whole tapestry of items and companies and what consumers are saying, what the macro looks like. But overall, I think consumers are engaged. I think there's a real bifurcation between the lower and middle income and the higher end. I think companies are more agile than they've ever been in figuring out ways to engage and convert the consumer. You're seeing it in the earnings with the haves and the have-nots. I mean, look at the strength yesterday. Urban Outfitters delivering a nearly 13% comp store sales increase with lower markdowns is impressive.
At the same time, you also have Abercrombie and Fitch continuing to show mid-teens growth at Hollister and sequential improvement at the Abercrombie brand. So, and then you have have-nots. I mean, Bath & Body Works has work to do in reconfiguring their transformation plan.
I see you're saying have and have-nots in terms of the retailers, not in terms of consumers, because we always hear about the K-shaped economy. You know, the top 10% or the top quintile is doing so well, the bottom 80% are struggling. Who is shopping at Kohl's? Who is shopping at Urban Outfitters? Who is shopping at Hollister?
Overall, you're seeing the lower to middle income consumers looking for value, and they're getting the shoppers. It's Walmart they're shopping at. It is Kohl's, the improvement that you've seen, but take a look at the off-pricers. At TJX, Ross Stores, and Burlington, they're capturing more consumers who are looking for value. Because even at the upper end, and we've heard it yesterday from Urban Outfitters, consumers are being more discerning, choiceful, and looking for value when they spend. The flags are out for promotions for Black Friday. 30 to 40% is what I saw as I walked the streets last night. We're going to see more tomorrow and Friday, and I do know a store that's open on Thursday because there's not a day I won't be in a store. Now I'm going to be in one tomorrow.
Will you be in a Target? What's going on with that
I'm going to be in Aritzia tomorrow because they're open. On the Target side, there's work to do at Target. Obviously, new CEO comes in, fixing store standards, enhancing product offering because competition is big. And it's big from Walmart, and it's big from the off-pricers.
Target was supposed to be, or it had been, at least in my experience growing up going to Target, would it be kind of exciting? You'd go in wanting one thing and end up buying a bunch of other things. How does a company like that in this moment, when you have choosy consumers, do a turnaround? Others have been successful. You were pointing at Kohl's, but is it a difficult environment to engineer that right now?
There's no environment when it's not difficult to engineer a turnaround. What you have, though, is you have the playbook of what was successful in the past to help you capture consumers in the future. What drives demand? Newness and value. The other thing that they have, convenience because of their locations. So let's watch over the next year and a half to see exactly what newness means to Target.
One of the other remarkable things in these earnings from the retailers was that margins have been looking pretty healthy, too. It was supposed to be a sector that was hurt by tariffs. You even had a president at the start of the week tweeting out or posting on X saying, those of you who have front-run tariffs and have been stockpiling, that's going to end, and soon you're going to be having to pay tariffs. Just that on its very surface, Dana, do the good margins continue?
Overall, one of the things we've been seeing with the tariffs, yes, we have been seeing price increases. We've been tracking 80 items of prices every week since April when the tariffs began to be put in place. And overall, we're seeing a gradual move up, particularly on footwear, but everything else, it's up and down given promotional times. Now, goods that are there, they're all tariffed right now. Everyone's watching India. There's concerns. But what have they done to manage their margins? The marketing spend is leading to effective conversion. They're managing the inventory levels. And overall, consumers are engaged. You can't bet against the U.S. consumer.
I'd never heard of Aritzia.
You haven't?
I hadn't. I see that they have 20 to 50% off everything right now, but also that their stock is up 368% over the past 5 years. This year alone, they've doubled. What is that?
Why haven't you heard of it? So what Aritzia is a Canadian apparel retailer with sub-brands. They're known for their Super Puff and their puffer jacket. They've just opened. They have 3 stores in Manhattan that are flagship stores. The newest one just opened in Flatiron on 19th and 5th. And they did a collaboration with Lucia Pizza and Aritzia. So if you want pizza, go to Aritzia, but they also have an A-OK cafe with the croissants too.
Matt, their thing is in the store. They have a giant version of their puffer, like as if a giant were to come down to earth and wanted a jacket, they'd go to Aritzia and buy it. You can pose in it, get in one of the sleeves. It's very fun.
I'm collecting Christmas ideas for Tom Keene. I'll get him one of those. Hey, I wonder about the SCOTUS case on tariffs. If they strike down tariffs and refunds then have to go out, do retailers stand to benefit? Is that something investors are betting on?
There's a lot of things for next year that could be tailwinds. That is certainly one of them. And yes, investors definitely look at that for retail. But we have a lot of events, whether it's the World Cup, whether it's the Olympics that are coming up. We have sporting events that frankly help drive demand. The other thing, tax refunds are going to come also. And you're going to lap the tariffs beginning in the second and third quarter. So those are all things that investors are looking at to say, what can we see the retailers bounce off of? We saw the big bounce yesterday because the retail stocks were oversold. We're going to watch through the holiday season, and Black Friday is here, so I hope you'll join me in the stores.
Maybe online, Dana. I don't know about in the stores. I don't know if I can handle that.
You gotta feel it, and you feel it in the stores.
Well, you can let me know what the feeling was, and I can live it vicariously. Along with the tax rebates, you also have the $2,000 promise checks coming out that Trump has said because of tariffs. Scott Bessent was talking to Fox News a couple days ago and basically said, we think Americans are going to save this money. Where do you think that money goes? Are Americans going to save this, or does that turn around, go right into the retailers?
I think they'll go into the retailers. You know what else? Look at experiences. Look at travel. You hear about all the travel for this weekend, people going to visit their families. Experiences create memories. And I think they're going to spend on that also.
There was that really negative note, I believe from Barclays, though, about Carnival, that they went and they talked to management and they were really down. That seems like a problem, Dana, because cruises has been one of those things we pointed to being like the consumer is doing really well. They're still out there. They're still spending. They're still traveling.
Right. I would think that travel overall, we've definitely have seen some of the higher price travel. Luxury is where it's at. The main cabin is slower than what you have with luxury and premium. And you've heard that from the Deltas of the world also.
By the way, there's been a bifurcation in luxury as well. I've noticed that some for example, Ferrari scared investors a little bit on their capital markets day. On the other hand, you hear from others, Lamborghini, which still doesn't have any problem pushing tariff cost increases. How do you see that? And I obviously only focus on cars, but how do you see it otherwise in luxury?
One of the things that came out with the European luxury brands that reported, whether the LVMHs or the Kerings and all the others, is sequential improvement. China's not getting worse for them. North America's driven by locals. But it all depends on what do you have that's of interest that the consumer doesn't have already to buy. And these collaborations mean everything, whether it's TikTok, whether it's music, whether it's sport.
Or pizza and puffer jackets.
Exactly. And I saw with the F1, didn't Beyonce just was at the F1 also?
She was there with Lewis
wearing
Hamilton.
a Louis Vuitton outfit.
Yes.
Okay.
Danny was there too.
Okay.
Not at the one Beyonce was at.
Oh, that was in Vegas?
And I did not have a Louis Vuitton outfit, although I wish I did. Dana, first of all, I'm very excited to hear what you buy on Black Friday. So please come join us again soon. And thank you for joining us before your shopping excursion into Aritzia. That's Dana Telsey of Telsey Advisory Group. Coming up on the show, we're going to get the latest jobless claims that are set to cross as a drip feed of economic data comes in among the fog that Jay Powell and crew are driving through. We'll catch up with Lydia Boussour of EY, who joins us next to react. You're watching Bloomberg Surveillance. Seconds away from the latest weekly jobless data, a market that is pushing higher for a fourth consecutive day after the biggest three-day gain since May. S&P 500 futures up 0.33%. NASDAQ outperforms despite the fact Nvidia is falling. That is up 0.4% this morning. Thank you, Alphabet. Meanwhile, your Russell 2000 futures, those are little changed, just higher by 0.07%. Meanwhile, data coming in, the latest jobless claims. Let's go over to Bloomberg's Mike McKee, who has the numbers. Mike?
Well, no help for the we need to cut immediately crowd at the Federal Reserve. Jobless claims come in at 216,000 after a revised 222 the prior week, suggesting we're still in that low hire, but very low fire environment. We're not seeing people being added to the unemployment rolls at a high rate at all. In fact, they're going down. On a continuing claims basis, 1,960,000. That's up slightly from 1,953,000, the revised number for the prior week. So jobless claims still showing a reasonably strong labor market, if not for getting jobs, at least for not losing them. Durable goods orders come in 0.5%. That is exactly as anticipated. These are September numbers. Capital goods shipments, orders, non-defense ex-air, the core group that we look at to simulate business spending, up 0.9%. That's 3 times as much as was expected and up from 0.4% in the month of August. So a strong business spending in a report for the month of September. We'll have to see exactly what categories those fell in. But at this point, we're still seeing some strength in the overall economy.
Mike, Danny and I have been talking about Fed independence, and it does seem like the president is just chipping away at that pretty consistently. However, maybe previous presidents have done so in their own way. Does the market care?
I don't think the market cares at this point because they still see the same cast of characters are at the Fed and nothing has really changed. They're concerned a little bit with the idea that the Fed is divided, but that's happened before. The real question is going to be when the president finally nominates a new chair and whether the market thinks that person is going to do the bidding of the president or do the bidding of the economy. That'll be when we really start to see the questions about independence flare up, Matt.
Mike, thank you very much for that. That is Bloomberg's Michael McKee. And it's a market that is not changing much off the back of that. Stocks still higher and yields still higher, too, coming back from a drop to 4% for your 10-year yield that moved to the lowest in a few weeks off the back of weaker economic data yesterday. Again, little changed this morning. Lydia Boussour of EY joins us now. Lydia, great to see you. It's the same kind of figures for jobless claims, low hiring, low firing, but it comes off the back of weak data yesterday when it comes to consumer sentiment, but really strong earnings. How are you currently interpreting the tea leaves?
Yeah, so we're finally starting to get some more visibility on how the economy fared heading into the government shutdown, but also how the labor market is evolving, looking at claims. And what I'm seeing is an economy that's holding up. But we are seeing some cracks beneath the surface. If you look at the labor market, there are no signs of broad-based layoffs. Claims are still fairly low. But then when you look at job growth and you look at how concentrated job growth has become, we are seeing, some fragility in this labor market. Companies have been using hiring and keeping a tight lid on hiring as a way to manage these higher costs that they're facing, and also all the elevated uncertainty that we are seeing. So it's, a labor market that's essentially holding up in this fragile balance and this, low fire environment, as you put it.
If it is fragility, Lydia, why do you expect the Fed to pause in December?
Well, we actually are seeing increased likelihood of that rate cut happening. I think it's a really close call. If you look at where we were a few weeks ago, we were coming out of the Fed minutes showing that many participants thought that, keeping interest rates unchanged throughout the end of the year would be the appropriate path. We had Fed Chair Powell on the back of the October press conference saying that it's not a done deal. Now, we've seen some soft data, as you mentioned. We're seeing a labor market that's still softening. We are seeing inflation still quite contained. There's no disorderly increase in inflation at the moment. And then we've heard those dovish comments from Fed officials. So I think, the odds of that rate cut have increased. Now, I think there is a lot of focus on that December cut. When you look at, the FOMC minutes, we saw that many participants and most participants thought that, a recalibration and more easing in policy is in the pipeline. So if it doesn't happen in December, it could happen in January.
So, Lydia, your forecast then, you get one in January, 25 basis points, and you get one more for 50 basis points of total easing through the year. Does that forecast change if it is Fed Chair Kevin Hassett that we have in 2026?
I mean, for now, if you think about the path for interest rates over the next few months, I think it's really going to depend on how the labor market is evolving. On the inflation front, our view is that we're likely to see a peak around 3% on inflation. We still have a little bit of inflation pressure in the pipeline, but I don't think that's going to be enough to lead the Fed to pivot again towards that, inflation risk and focus on the inflation risk. So if you think about the labor market and what's going to happen in the next few months, we do expect to see more softness in the labor market and remaining in that sluggish job growth environment. And we think that, there's going to be a little bit more room for the Fed to continue that recalibration and ease policy, at least in the first quarter of the year.
Is that going to help, Lydia, the labor market? I mean, we had news from HP this morning saying they're to cut 4,000 to 6,000 employees because they're using more AI tools. In that case, why does it matter if rates come down?
I think, what's been really happening in terms of hiring and business decision is really the elevated uncertainty we've been in over the past year, which has led companies to really hit the brakes on hiring, but also using wage compression as a way to manage cost. And that means that wage growth has continued to slow. We've seen wage growth slowing at the lower end of the income spectrum even more than for higher income households. And so if you think about next year, we've got a little bit more certainty on the policy front, or at least we're getting past that big uncertainty cloud that we had this year. And then there are a few tailwinds when you think about 2026, thinking about some fiscal spending, but also the economy essentially gradually picking up throughout 2026. So I think the labor market is going to remain in that soft environment, at least in the first half of the year, and then we expect to see a gradual pickup. And consumer demand, this labor market is really going to lead to slower income growth and lead the consumer to also slow down. So I think we got a great summer and an economy that was carrying a lot of momentum, but heading into the end of the year and into early 2026, we do expect to see a bit of a slowdown in the economy.
But Lydia, what if we get $2,000 checks? What if it's a Fed that starts to inject more liquidity? What if we get tax rebates? These seem to be big drivers of growth. What is the line between the slowdown that you see and potential for reacceleration?
Yeah, I mean, these would provide some support, probably more on a one-off basis. So you would see, a boost to consumer spending from those checks. But if you think about the environment we are in today and the environment we were in today, during the pandemic, for instance, when we got the checks back then, we still have an economy that is, a lot more into balance when it comes to labor supply, when it comes to, looking at goods supply as well. We had a lot of supply disruptions back then. So we might see a bit of a bump in demand in early 2026, but I don't think that would be a source of sustained upward pressure in the economy and lead to the economy to essentially run hot. So I think when you think about 2026, we're looking at an economy that will be more operating around trend than an economy that's going to be overheating.
Lydia, wonderful to catch up with you this morning. That's Lydia Boussour of EY. Meanwhile, Bloomberg's Mike McKee has been standing by, digging through the details of the latest data release. Mike, what you looking at?
Well, as Lydia said, we had a pretty good summer, and it continued into the month of September in terms of business spending. Overall, as we mentioned, durable goods orders come up 0.5%, but the capital goods non-defense ex-air proxy for business spending is up 2.6%, and you can certainly parse out the possibility it was AI, and construction of factories or plants for that. Because we see electrical equipment up 1.5% and computers and electronics up 0.5%. What durable goods was not was a Boeing-affected data point this time. The non-defense aircraft orders were down 6.1%. Automobiles still a fairly strong 0.4%. So still good news on that front. And it's overall a good news story, even if that is September, adds to third quarter growth. But I think the thing that the markets are going to take away today is that 216,000 jobless claims. That's the most recent data we have. That is the lowest since April.
Mike, are we already seeing this incredible, AI data center capex lead to an addition of jobs or an addition of growth in this economy?
No, we're not. I mean, we are seeing it add to growth. The business spending on goods to create these factories is showing up. What's not showing up is a lot of buying in other areas. Machinery orders this month were up just 0.1%. And we have seen a number of months in a row with manufacturing jobs contracting. So we're not there yet. Scott Bessent says it's coming. We'll wait and see.
What about the flip side of that, Mike? Matt was talking about it, the idea that you have HPs of the world announcing that they are laying off workers, yes, over the next 3 years, but because of AI.
Yeah, that's the question that nobody can answer is how fast will AI affect the workforce? And actually, how will it affect the workforce? Will it mean the loss of a lot of jobs? We really don't know what jobs there are going to be coming out of AI yet. And we don't know how that is going to affect the labor force. That's something that everybody's trying to figure out. Nobody really has a good clue as to what it's going to be like 5 years down the line.
And yet, the companies are making the announcements. Mike, thank you so much. Bloomberg's Michael McKee. I think that's the point. Nobody knows what the world is going to be looking like. Nobody knows how productive AI will actually be. So are companies really laying off people because they're using more AI?
Right. Well, but it could be drastically different than we expected. You know, I remember in the week of the DeepSeek announcement, reading a story in the New York Times about how in the future, countries that are turning away immigrants now are all going to be fighting for labor, right? But maybe that's not the case. Maybe we're going to be sitting on the beach collecting a universal basic income because AI does our jobs for us.
And every day is a Black Friday sale, eating turkey. I love this idea heading into Thanksgiving. All right, let's get an update on stories elsewhere this morning. Here with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, Danny. Well, just recapping the official data released. Initial jobless claims coming in at 216,000 for the week ended November 22nd. That's lower than the estimate, which called for 225,000. And it's a tick down from the prior week of 220,000 claims. Now, continuing claims for the prior week totaled 1,960,000, about 300,000 less than estimated. Volkswagen is bringing back its Scout line of SUVs and pickup trucks as a brand of hybrid vehicles. The Scout line was originally conceived to be made as EVs, but consumer deposits for the new models showed a strong preference for plug-in hybrid versions over EVs. Volkswagen plans to start production in 2027, with the starting price of around $60,000. U.S. airlines are preparing for the busiest Thanksgiving travel time period on record. Airlines for America predicting 31 million passengers will travel from November 21st through December 1st. A cold snap and forecasted thunderstorms are raising the threat of delays. Fuel supply constraints and tech outages could also add disruptions. And that is your Bloomberg Brief. Danny.
Bonnie, thank you very much. Coming up next, Venu Krishna of Barclays as he's raising his outlook for the new year. Plus, Vonnie Quinn returns with your morning movers. Deere shares losing traction after an outlook disappoints, down nearly 5% in the pre-market. This is Bloomberg TV.
No doubt we will face opposition again, but I have yet to see a credible or a fairer alternative plan for working people. These are my choices, the right choices for a fairer, a stronger and more secure Britain.
UK Chancellor Rachel Reeves unveiling the autumn budget, getting now a good reception from markets. Originally, with an early release from the OBR, markets freaked out, sold gilts. Now gilts are rallying. So too is the pound, up 0.2%. For this equity market here in the U.S., it appears to be another day of a rally, up 0.3% for the S&P. NASDAQ outperforms even more as Russell 2000 futures are flat. We're just under 1 hour away from the cash open. Here with your morning movers is Vonnie Quinn. Hey, Vonnie.
Hey, Danny. Well, we still have some stragglers when it comes to earnings. Let's start with Workday. It's already had a pretty difficult year to date. It's down 13% and it's down another 6% pre-market. So it came out with results. Analysts have been a little bit worried about Workday because it's a cloud software company and they're wondering how generative AI tools are going to impact this company. Now, in terms of this quarter's results, it either met or very small beat on most of the metrics. However, the Q4 guidance was pretty conservative and it misses on its Q4 guidance in terms of margins. And this has a lot of analysts downgrading or price target downgrading the stock. Price targets lowered at UBS, RBC, Bernstein, but we did have Morgan Stanley raising its price target there to 280. Let's take a look at a different story. Autodesk. Flat this year, but it beat and raised, and it's up, as you can see, more than 7%, getting a big analyst reaction. Upgrades at Deutsche Bank, price target upgrades at Bank of America, Wells Fargo, UBS, BMO, Barclays, it goes on and on. The deal here is that one of its verticals, the design vertical that encompasses architecture, engineering, construction, operations, that saw a 23% increase. It also said, look, we've been using AI for the last 10 years with in-house products. The whole macro AI picture is not going to change what we do and how we do it one bit. And that's getting a very generous reaction. Deere, this is the farming community. We know they've had a tough time. Big Ag, it appears, has not seen the trough yet. According to Deere's CEO, that'll come next year. Now, so it missed in terms of margins. It also missed in terms of its forecast for net income by a big margin. So Bloomberg estimates were 5.3 billion. It's going to be between 4 and 4.75. So that's quite a big miss. One bright spot, as I mentioned earlier, is that for small ag, there was growth there, revenue growth of more than 10% on things like turf and smaller machinery.
Bonnie, thank you very much. Those shares down 4.6%. Looking ahead to the new year, Venu Krishna of Barclays is raising his 2026 S&P 500 price target to 7,400, writing, "We see upside to tech EPS estimates as megacaps continue to execute and with the AI race showing no signs of slowing." I'm pleased to say that Venu joins us now. I got to say, you could even look at that as a very conservative forecast, given Deutsche Bank is somewhere around 8,000. So what gets us to 7,400 next year?
I think a good part is through earnings. So we are expecting earnings to increase double digits, around 11%. In our upside case, obviously, we expect that to be a little stronger than that. And we are being conservative on the multiple front, because if you've seen, especially the fulcrum of this market has been big tech. And there, multiples have been moderating as they earn into their multiples.
It is a year where it does feel like that bullish case is easier to make. But if you're to make the flip side argument, you could look at what happened over the past week. Maybe you get a disappointment that the Fed doesn't cut as much. And that really hurt the AI trade. And all of a sudden, questions were asked about whether they could keep spending and whether this would be a market that would keep funding them.
Yeah.
What happens if we get more of that next year? If leadership is in doubt, can you get to 7,400?
I think it'll be challenging because you do need tech to deliver. And we are very positive on the overall TMT space. And this is how we think about it. So you're talking about how to think about the downside scenario, right? In what ways can we? So I think a slowdown in the AI narrative driven by the capital spending is certainly one of the things. But when we dig into it deeper and recognize that the AI trade is far beyond the hyperscalers, and hyperscalers are in actually pretty good shape, what we think is the earnings risk is limited, but the valuation risk is higher. So in a scenario in which the AI narrative shifts away, then we can see a 10 to 15% correction in the equity market. However, a less probable but a more dangerous outcome is one in which you have an economic slowdown, which is triggered either by weakness in the labor market and or inflation moving the wrong way. That is likely to then be accompanied with a corresponding pullback in AI capex as well. That combination is going to be far worse and could result in a 20-30% correction. So that is, I think, a real tail event, but it is worth pondering that in an environment like this.
Well, that could come from, we had Schneider Electric say that by 2028, the amount of electric generation available at peak times will not be enough to match demand if we hold the same backup capacity. So, you know, the grids, it's no surprise to anybody, are old and decrepit and really need work in this country and may not get it. Could that have the same effect as the economic slowdown that you're concerned about?
Absolutely. In fact, if you think about the AI capex and think what can derail it, we actually discussed that in detail about a month and a half ago. And the first among that is the power wall, is the power constraint you're talking about. Because right now, while on one hand, the demand for compute is far higher than supply is being constrained by power, right? And so that is a very real constraint. The second is in the technology itself. What if the models themselves start leveling off at a time where the rest of the software and the component technology improves? So in other words, it is the risk of the dark fiber moment for AI, where the amount of usage demand for the infrastructure is a lot less than what you've built, right? It's something harks back to 25 years ago what happened.
By the way, for those who weren't there, dark fiber is what we called all the excess fiber that had been laid in 2000 and no one was using, right? And this is the concern that we could be seeing history repeat itself.
Right, but I think more than that, one of the constraints we did point out was about financing. That has now come to the forefront. So right now, the two issues people are concerned about is the power constraint. I would still say that's number two, even though that's very real. And in my mind, that's the number one constraint. The other one is financing. As the AI sort of capital spending is moving to credit markets, increasingly people are focusing on can that market absorb that scale of issuance, and where is risk pricing and clearing in those markets?
And who's more focused on that than anyone else?
What's that?
You know who's more focused on that than anyone else?
He's talking about me,
Danny
for
Berger.
sure. But I think it's kind of analogous to the power thing. There's so much power needed. These are power-hungry projects. They're also capital-hungry projects that you need financing to come from every corner, be it private credit, be it from syndicate bond markets. So what does that mean if any one of those corners starts to back off? How fragile is it? Or do you think it is a funding market that will be willing in every aspect to throw money, even if OpenAI is just lighting it on fire and losing some money?
No, that funding market is going to be more disciplined, right? And one of the sources you didn't mention, we wrote a note yesterday, was that just in the AI infrastructure, $130 billion has been raised in the US convertible bond market, right? So that's a market which is humming right now because a lot of it, we are estimating, broadly speaking, about 60-70% of the market is now AI-based, right? And so even if you look at the credit markets, Amazon recently issued a much bigger credit transaction. Now, it was way oversubscribed. And the last I checked, it was trading a little tighter than where it was priced across 6 different tranches. So I think each market will determine the right pricing. And you need to pay attention, though, how that's being priced, because it will ultimately have implications for the equity markets as well.
Venu, not enough time with you. This has been so fascinating. Venu Krishna of Barclays, thank you so much. Fortunately for everyone else, if you're not sick of Matt Miller and me yet, we will continue on for the next 2 hours getting into your market open. In the meantime, coming up on this show on tomorrow, Ben Laidler of Bradesco, Jelena Sokolova of Morningstar, Ian Hartnett of Absolute Strategy. This was Bloomberg Surveillance.